respect the trend, but don't ignore the risks as we go into 2026.
Earnings are going to be what drives stock prices.
You're going to see a lot of churning, but have moderate returns.
I still think tech is long-term leadership.
There's a 30% chance that you get a full-on bubble next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into 26, hitting the ground running.
We're going to run the country until such time as we can do a safe, proper, and judicious transition.
President Trump is done negotiating. He proved that.
We are not going to be able to allow in our hemisphere a country that becomes a crossroads for the activities of all of our adversaries around the world.
The United States striking Venezuela, capturing Nicolas Maduro, as President Donald Trump vows to, quote, run the country for now, and markets adjust to an uncertain future for the biggest oil reserves anywhere on the planet.
John, it's great to have you back. Welcome back this morning. Congratulations, especially after what we saw this weekend, a seismic shift when it comes to geopolitics and U.S. foreign policy. A stunning raid, a bold moment for the United States, capturing Nicolas Maduro, who is now just mere miles away from where we are sitting in Brooklyn and a New York prison. When you look at what's going on, Trump continuously spoke over the weekend about plans for U.S. oil companies to go tap those reserves. There's only one U.S. oil company there right now, and they've been there for 100 years, and that's Chevron. Will others actually follow suit?
I think we have to make a note that over the weekend, impressively clean move over the weekend. The question now is, how messy is the next move going to be? How messy are the weeks, months, and maybe years, decades going to be still to come?
I think one of the most important statements we had over the weekend is actually from Delcy Rodriguez. This is an individual who's a Maduro loyalist. She was number 2. She's now the acting VP. Over the weekend, she called what the United States did barbaric. She said it was a kidnapping, and then there was a change of tone yesterday. She said, we extend an invitation to the U.S. government to work together on a cooperation agenda. Does this administration think they can actually work with Delcy Rodriguez? And if so, what does that look like for U.S. oil interests, as well as geopolitically in terms of pushing back China, pushing back Iran, and pushing back Russia in the Western Hemisphere?
You mentioned Chevron. That's a stock to watch this morning. That stock up nicely in the pre-market. For the broader market, equity futures so far positive by 0.3%. Coming up this hour, a stacked 60 minutes. We'll catch up with Robert Koenigsberger of Gramercy as the U.S. seizes Venezuela's leader. Laurie Cavasina of RBC Capital joined us on the outlook for stocks in 2026. And Jayati Barawaj of TD Securities calling for a potential dollar crash by the middle of this year. We begin this hour with our top story. The White House taking control of Venezuela's leadership. President Trump saying the U.S. will run the country for now.
We're going to run the country until such time as we can do a safe, proper, and judicious transition.
President Trump is done negotiating. He proved that.
We are not going to be able to allow in our hemisphere a country that becomes a crossroads for the activities of all of our adversaries around the world.
So here's the latest so far this morning. Venezuelan leader set to appear in court in New York City later on today. Bloomberg's Mika Solna joins us now from Washington for more. Washington, no doubt, Mika, interrogating the rationale for the moves over the weekend. What's the latest so far this morning?
Yeah, absolutely. A lot of lawmakers on Capitol Hill, as well as many conservatives around the Trump movement and his organization, as well as the White House, have a lot of questions about what's going on here in terms of the White House's posturing on Venezuela. We're going to see the president meet with House Republicans tomorrow. I think there will be a lot of questions raised. A lot of the contentment has fallen on party lines in terms of the response to this, but this could be a move in terms of how Trump is going to posture in other countries moving forward as well.
Baker, in many ways, this administration being refreshingly transparent about what the objectives actually are. In fact, incredibly transparent in the national security strategy that they put out at the end of last year in November 2025, which makes me wonder if they're this open and honest about what they're doing in Venezuela, what's next, who's next, and where should we be looking?
Yeah, absolutely. I mean, President Trump has hinted at other areas of the world where he believes that there is a level of unfairness or national security interests at risk there. So he's mentioned Panama, for example, or even Greenland. And these are areas that we could be looking at. But he's also issued warnings in other places in South America. It's the Colombian president, for example. So everyone's going to be watching with the great scrutiny in terms of what Trump does next. And I think this is a great message in terms of how he's going to play out the next 3 years of his administration.
Mika, thank you. Mika Solner down in Washington. We'll have more from Mika later on in the show. This came out in late November. Take a look at this quote. The United States will reassert and enforce the Monroe Doctrine to restore American preeminence in the Western Hemisphere. They couldn't have been any clearer.
Page 5, page 15 of that document you're talking about, they were talking about now as he's calling it over the weekend, the Monroe Doctrine, on how they want to make sure they are shoring up national security concerns in the Western Hemisphere. And the president was pretty honest about Venezuela for the entire year. And now he's talking about Cuba, Colombia. He's had threats towards Iran as well as Greenland, all in the last 72 hours.
Here's the view on Wall Street so far this morning. Robert Koenigsberger of Gramercy Funds, one of the leaders in emerging market investing, writing the following. The immediate goal was the removal of Maduro. Objective achieved. The current path is a small R regime change. This is the optimal option. Robert joins us now for more. Robert, welcome to the programme. I know you mentioned this going into year end, thinking about 2026 and beyond as we go through the national security review coming out of the administration. As you take a step back and think about things, how does reasserting the so-called Monroe Doctrine change the market map in Latin America and maybe beyond?
Good morning and Happy New Year and welcome back. So look, I mean, I think to start with, what occurred yesterday was not really regime change. It was the extraction of the leader, or really decapitation of the leadership of this regime. So as we go forward and think about what's going to happen in Venezuela, it looks like the current base case is Delcy Rodriguez, the vice president, will lead some sort of transition. Hence the small R regime change that we talked about before. When we pull the lens back on Latin America, I mean, certainly, and as I mentioned on this show last month, I totally agree. I think what this is about is not about necessarily the re-democratization of Venezuela, but the recapturing of the Americas for the United States. The Monroe Doctrine, the Roosevelt Corollary, and now what everybody's calling the Trump Corollary, or the Monroe Doctrine. So what is it? It means different things for different countries. Hearing previous speakers this morning talk about Colombia, I'm less concerned about seeing action in Colombia. Colombia's got an election coming later this year where it's pretty clear that the right is scheduled to return to power. Action there could only probably hurt the right and actually embolden the left. So that probably wouldn't be a great move. But there's a move towards the right in Latin America, and these things tend to happen in trends, towards dictatorships, towards democratization. And I think we're seeing a move towards democratization.
We've seen that in Chile, in Bolivia, in Argentina, certainly governments that align more closely with the thinking of the current administration. Robert, are there limits to this? How much further can things go in places like Brazil? Do you believe the pendulum will swing back in the other direction there too?
Yeah, I mean, it's hard to say. I mean, the leader of the left is not a young individual. And Brazil has its challenges. Brazil reminds me a little bit more of Argentina, where there's just this core base of the left within Brazil that will always support Lula or whoever Lula supports. So I think Brazil will be interesting. I think the jury's still out on that.
We heard from Panama's leader over the weekend who said that Delcy Rodriguez is Maduroism without Maduro. Do you think she can generally change the country and the U.S. could direct interest towards Washington with her in power?
Look, I think it's possible. I mean, I think the bet that the administration made is that, let's say that leaving her in place was the least worst option, or the optimal option. And what I mean by that is going from Maduro to Machado was probably a bridge too far, and that, Machado and the opposition hadn't really demonstrated that they could control the state. The problem with Venezuela today is the state has been destroyed over the past 20, 25 years. So there needs to be elections tomorrow, and putting in the opposition is not going to solve the issues of Venezuela. I think you need to start by rebuilding the state itself, the institutions, the courts, what have you, before you can expect to, have democratization take hold for a long period of time.
Do you think American CEOs will follow suit and will want to go back into Venezuela?
I do, particularly around the oil sector. As previous guests have mentioned, Chevron's there today. Wouldn't be surprised to see ConocoPhillips and others, the Repsols of the world. But then you go below that, you have all the suppliers, the Schlumbergers or the Halliburtons of the world, and then folks below those that need to be supplied. So I do think there's going to be a big exodus. When you think about Venezuela, think about prior states that had failed that needed to be rebuilt. What comes to mind for me is like Peru, when Fujimori came in, a complete rebuilding of the state, financial services, insurance, banks, what have you, grocery stores. I mean, just the basic things for a country, and also Iraq. I mean, if you want to think about the potential for Venezuela today, think about Iraq when the Marines invaded. They were doing about 1 million barrels a day. Today, they're doing 5 million barrels a day. The GDP was something like 25 billion. Today, it's 250 billion. So there's that type of tremendous potential in Venezuela today. And I think it's going to be hard for American and international CEOs to ignore that.
So, Robert, these are companies that in the past have been burnt. Do you think they'd be willing to make a multi-decade commitment at this point? And what do you think companies like the ones we're talking about would need to see before they really put money to work?
Yeah, I mean, I would suspect, John, that it would be incrementalism. That, if a new company is going to come to Venezuela or come back to Venezuela, it's not going to be all in at once, but it'd be incrementalism. And if you look at Chevron, they're not doing today what necessarily they were doing yesterday, but they're hoping to do more tomorrow. So I think everyone would think about a foothold today. The Rodriguez administration is clearly a transition government. If I were going to Venezuela, I'd want to understand what that transition was toward and how strong that new transition would be before I went, all in.
So the Rodriguez government at this point, I'm not sure if they see it quite the same way. They understand that this is obviously not going to be the finished article. But ultimately, Robert, I wonder, we didn't see much resistance over the weekend. How much resistance would you expect to see in the coming weeks and months?
Look, I mean, I think the lack of resistance demonstrates that there was some sort of collaboration before the extraction. And I wouldn't be surprised to see, some sort of quid pro quo, which is you behave, this administration, this transition, you behave in a certain fashion, you will get the immunity, let's get, transition to new elections. And, there are examples in Latin America of leftist regimes that were dictatorships that participated democratically and lost and came back. I mean, I'm thinking about, Nicaragua in the early 1990s. The Sandinistas controlled Nicaragua for a decade. There was an election. Daniel Ortega lost. And then in following elections, he was able to come back. So that may be the path for the Chavistas, which is some short-term loss for some medium-term to long-term prospects.
Robert, as you know, there's a lot of distressed debt connected with this story. I just wonder from your perspective how you're thinking about how much recovery assumptions should shift. Are there limits to how much it should shift?
Sure. I mean, if you look at prices this morning, I think Venezuelan bond prices, PDVSA bond prices are up about 8 points. So that's 20% on Venezuela, 30% on PDVSA. And that compares to, they're probably both up 3 to 4 times since the sanctions were lifted in October of 23. So there's been quite a run. And I'd say the asymmetry that was there is certainly not there today. But that being said, if you look at the type of state that the Trump administration is signaling will be built, there can certainly be more upside. I would expect that upside to be maybe the pot of gold to be a little further out, but the reward higher. And I think the key is going to be what type of restructuring ensues and when that ensues. And I wouldn't expect that during the transition government. I would be surprised. Typically, you need to see a stable government that's signaling multilateral harmony and then signaling a bond restructuring. It's certainly not their first priority. But, I would think about some sort of patient capital bond approach where the long-term value of Venezuela is undeniable. And bondholders, stakeholders, companies, foreign direct investment, the challenge would be how does everybody come together in a fashion that's not a zero-sum game?
Robert, for the people who had the foresight to get in early, they might see developments over the weekend as an exit point, not an entry point, and they're thinking about the next trade related to this story, just one piece of a much bigger puzzle. What's your approach to that at the moment?
Look, I mean, I was asked about this more broadly yesterday in terms of, is there going to be this flood of new investment into Venezuela? And we have to remind ourselves that this is still an OFAC-restricted country. In fact, the president herself is a sanctioned individual. The head of the Congress is a sanctioned individual. So in order for the floodgates to open up to Venezuela, there's going to have to be a change in the sanctions regime. And that certainly hasn't occurred yet. And what I mean by that is you just couldn't simply get on an airplane if the Caracas airport was open and start knocking on doors and having conversations, because these are still sanctioned individuals. That being said, there's a lot of examples in emerging markets over the past 10, 20, 30, 40 years that there's certainly upside from prices here in the 30s.
Robert, good to see you. Let's catch up again soon. This story's not going away anytime soon. Robert Koenigsberg there of Gramercy Funds Management following the stunning developments over the weekend. Big question, I think, for many, is this Panama of the late 80s Or is it Libya decades later?
It's a huge question going forward, and this is why I think when Marco Rubio over the weekend was talking about how this is going to be a process, and they're going to continue going after some of those boats, making sure that there are sanctions in place while they work out a transition, and they want to see the country moving in a direction that then they can maybe do something like lifting sanctions. To Robert's point, you can't just go in right now. There's a ton of sanctions. These people on OFAC lists, the only U.S. company there is Chevron. And to your point, they've got burned in the past. Exxon, ConocoPhillips. 2007, they left because Hugo Chavez nationalized those assets. You have to think, is the risk going to be worth the reward where the oil price is trading today?
So far, so good for Chevron, up in the pre-market. Early days, of course. Equity futures more broadly positive by 0.3%. With an update on stories worldwide this morning. With your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Good morning, John, and thank you. And let's stick with Venezuela. The acting leader of Venezuela, Delcy Rodriguez, asking the U.S. to work with her country. A sharp turn from her initial statement calling for Maduro's return. President Donald Trump saying some rebuilding will be needed in Venezuela, warning Rodriguez that if she doesn't do what's right, she is going to pay a very big price. Denmark's leader is warning President Donald Trump to stop threatening to annex Greenland. Mette Frederiksen writing the U.S. has no right to annex any of the 3 countries of the Kingdom of Denmark. President Trump argues the U.S. control of Greenland is necessary for national security and says he'll revisit the issue in 2 months. The operators of a Swiss bar where 40 people were killed on New Year's Eve are facing a criminal investigation and possible charges of negligent homicide. The fire, which may have been caused by sparklers igniting the soundproofing insulation, also left 119 people injured. According to multiple reports, the bar in the ski resort of Crans-Montana is owned by a French couple. That is your Bloomberg brief, John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in about 30 minutes' time. Up next on the programme, the bull market entering its 4th year.
The questions are, sustainability. We've had 3 good years of double-digit returns. Can we extend that to a 4th? As a responsible investor, you stay the course. If it ain't broke, don't fix it. But you need to know where some of the pitfalls are.
Up next, we'll catch up with Lori Calvasina of RBC Capital Markets, live from New York City this morning. Good morning. Three-year winning streak for the S&P 500, another year of double-digit gains. So far this morning, equity futures on the S&P shaping up as follows. Higher by 0.3% on the S&P 500. On the Nasdaq 100, up by 0.67. Under surveillance this morning, the bull market entering its 4th year.
The questions are, sustainability. We've had 3 good years of double-digit returns. Can we extend that to a 4th? As a responsible investor, you stay the course. If it ain't broke, don't fix it. But you need to know where some of the pitfalls are. Look at them in advance and identify the insurance plays. All of these aspects are important, but look at it on an individual market basis, rather than you think that there's one insurance play that can defend against everything. I don't think that works anymore.
So here's the latest this morning. Stocks rising to start the first full trading week of the new year. Lori Calvasina of RBC Capital expecting the S&P to continue rallying with a 12-month price target of 77.50. Lori joins us now for more. Lori, good morning. Good to see you.
Good morning.
How is 26 going to be different to 25?
So look, I think we come into the new year prepared for some volatility. We've said that our target we think can absorb, 5 to 10% drawdown. That's garden variety. I do think some of the themes from last year are continuing into this year. What I really sensed in December was a strong sense to rotate and to seek out value. And so there was a lot of interest in not just talking about the AI trade. And frankly, I wouldn't say everybody's come to, to the moment where they hate that trade and want to abandon it. But, there's just more interest, frankly, in talking about what's cheap and what's maybe the next leg of that trade. What are other sectors that could benefit it from down the road? So I think in some way things are the same, some way things are different.
Can we take stock at 25? If you just went off the headlines, you'd think it was all multiple expansion. Just how powerful was the earnings story last year?
So look, I think that companies were absolutely brilliant in terms of their ability to manage through. And I think this is actually something that we've seen dating back to the first trade war back in 2018. And I feel like as a strategist, every year since then, I'm writing at the end of the year, companies really came through, managed the bottom line very, very well. We saw that also around the SVB crisis, which wasn't an earnings story, but was, sort of a managing through an issue type story. And so I think companies proved themselves once again this year. I did get a little bit snarky towards the end of the summer saying if there were all these cost savings, why weren't we getting them back in 2024? But the reality is they did find ways to kind of dig down deep and battle through some issues.
Earnings growth, great. But if you look at what was happening with payrolls growth, not so good.
Yeah.
That decoupling, can that continue through this year?
So look, I think that if you go back to the summer, what we started to hear, and I remember you and I talked about this on the show at one point, that people really moved away from 2025 and started looking at 2026 very, very early. And one of the things I heard in the summer of 2025 conversations was whatever the ripple effects are from some of these policy developments we got in the first half of the year, if there are job losses, whatever, if they happen, sort of later this year, we think we paid the price for them in April. What I think investors have really gotten bulled up on is a very strong economy in 2026. And the same, sort of conversations I was hearing over the summer, I was hearing a lot about that in December as well. I know just a lot of building excitement on the economy. So if for whatever reason we were to see pressures on the labor market, really kind of extend deep into this year, I think that is the kind of thing that could generate some volatility.
When it comes to policy, foreign policy, front and focus this morning after what happened over the weekend in Venezuela. Do you have a different view on energy companies this year now?
So, it's funny. Energy is one that, as a strategist, it's a fairly tiny part of the S&P 500. I find a lot of my clients on the institutional side are market weight by default. We have a market weight view. We have sort of separated out our market weight sectors into those that look better with good valuations and those that look more expensive, which were sort of on the first lines of the AI trade. I'd put energy in that category of ones that has better valuations. So it's kind of the upper tier of our market weight sectors. I did not find a lot of interest in talking about that sector in December. I would say particularly in Europe, maybe a little bit more in the States. What's interesting to me, on December 22nd, we did our year ahead sector outlook, and we saw very cheap valuations in that sector. Earnings revisions have actually started to improve already, driven by the oil and gas names. And the flows have actually turned around for that sector and are looking pretty decent as well. So I'm going to be curious as I get back out on the road this week to see if the tone has changed.
You also have an upgrade to communication services and healthcare. Why those three?
So it goes back to kind of looking through the sectors with cheap valuations and trying to find where the best opportunities are. So the four overweights, two of the legacy ones are materials and financials, which we think still give you pretty reasonable valuations. Communication services is among kind of the three big growth sectors, comm services, consumer discretionary, and tech, the one that has a clear valuation story. Earnings revisions have also been improving in that space. And we do think growth investors, there's only so much value they're going to buy, so you kind of have to find certain things within their wheelhouse. If you look at the healthcare sector, this is one that has been discussed at length for the last few months. We watched it for a while. We sort of flagged it as interesting back in October on a tactical basis. But we found that the curiosity about this sector really just persisted in December. And we had conversations with a number of clients indicating that people are just not positioned there yet. Similar to what we're seeing on energy, you've got good earnings revision trends, good valuations. And what I would say about healthcare is it's pretty broad-based at the industry level, so you have a lot of different choices.
Can we finish on discretionary? It came up there. What's going to turn this story around?
So for me, I will tell you the valuations just don't look cheap. And some of the more, sort of tariff impacted sectors don't look cheap on our industry valuation work. So, we have not been fans of that sector. Our analysts are cool on it. When we look at our analyst survey work, that's another component of our process. I'd like to see my analysts get more constructive. I'd like to see those valuations improve, and I just haven't been seeing that.
Laurie, the first of many appearances later this year, I'm sure. Laurie Cavassina there of RBC, looking ahead to a year full of event risk, and it starts later on this Friday when we get the payrolls report.
Absolutely. The payrolls report is going to be huge because everyone has been wondering what potentially is going to be a clean read when it comes to U.S. government data because of the more than 40-day government shutdown. Well, January, we finally get a clear read on what is going on in terms of the labor market.
It's amazing how irrelevant that slowdown in payrolls growth actually was for this headline equity market. Likewise, the tariffs from April of last year didn't seem to shake this market up at all going into year end. Futures this morning up by 0.3%. Up next, we'll catch up with Jayati Bharadwaj of TD Securities, warning the US dollar could crash by mid-year. That's next. You're watching Bloomberg TV. Three-year winning streak on the S&P 500, looking for year four. Double-digit gains on the S&P, on the Nasdaq 100 this morning. We add just a little bit of weight to that. Equity futures up by 0.3% on the S&P, on the Nasdaq up by 0.65. In the bond market, what a move we saw in the bond market. Remember Sal America? Remember all that talk back in April of last year? Showed up in the FX market, not in the bond market. Two-year bond yields adjusting to lower rates of the Federal Reserve. 10-year bond yields dropping 40 basis points in 2025. Yields a little bit elevated at the long end of the curve this morning, down by 2 basis points, 485.18. If you're tuning in to check out where the commodity market is, oil pretty much unchanged. Off the back of some stunning moves over the weekend. WTI 57.48, Brent crude 60.84. This is one of those stories where it's going to take time to show up in the oil curve. It's going to take time to see how easy it is to scale up production in a place like Venezuela.
And you're not really seeing a move in crude prices because we are going into 2026 or in 2026 with the IEA saying we're having almost a 4 million barrel a day glut right now. And you saw prices depressed last year. U.S. crude prices down some 20%. I think if we were at, say, $100 a barrel, potentially the move would have been bigger. And to your point, it is a very long road, given the fact that there are still sanctions in Venezuela, and it has been decades of mismanagement in Venezuela for these oil companies to potentially want to go in. It's going to be billions of dollars. Is the risk versus the reward where oil prices are trading today?
The worst year since 2020 on WTI through last year. This morning, 57.46. With 3 hours until the opening bell, let's get you some single names, some morning movers. Here's Danny Berger with more. Morning, Danny.
Good morning, John. Oil might not be reacting, but equities are, specifically Chevron. Look at this move, up more than 7.5%. Chevron largely seen as one of the biggest beneficiaries, if not the beneficiary, if indeed the U.S. takes control of Venezuela's oil production. Chevron's the only U.S. company that's currently in there, so it would have the resources to really go in and help rebuild, although company management, at least previously, has been more vocally focused on other regions besides Venezuela. It's not just Chevron that's moving, it's also companies like Exxon, ConocoPhillips. Those two are also seen to have the size and the experience in the country to help rebuild the oil patch there. They were in the country previously. They left in the 2000s when Hugo Chavez nationalized the Venezuelan oil production. Also, Halliburton, some of those energy supplier companies also moving to the upside this morning. That's up nearly 10%. Finally, ending on a different note this morning, a little bit of deal news. Bloomberg sources telling us that Apollo and a group of other investors might invest more than $1 billion in QXO. The announcement could come as soon as today. It's a distribution company led by billionaire Brad Jacobs. This would allow them to be more aggressive with acquisitions. Those shares up 9% in the pre-market. John?
Very cool. Danny, thank you. Thanks for the update. Hoping to catch up with Jim Zelter of Apollo a little bit later this week. On our radar this morning, Venezuela's acting leader, Delcy Rodriguez, calling for a cooperation agenda with the U.S. President Donald Trump, warning Rodriguez, quote, if she doesn't do what's right, she's going to pay a very big price. Elsewhere, Maduro and his wife set to face a U.S. judge this afternoon. Prosecutors alleging the pair illegally enriched themselves as they conspired to flood the United States with cocaine. The charges could keep Maduro behind bars for the rest of his life. And finally, the president suggesting the U.S. could take action against other countries. The president vowing to dismantle the Colombian drug trade and offering to deploy U.S. troops to clean up Mexico. Trump also renewing his desire to take control of Greenland.
I think given the events of this weekend, anytime now the President of the United States really does come out with a threat, you need to take it seriously. And I think the international community knew that in June when he went after the Iranian nuclear facilities. There have been strikes in the second term in Syria, Iraq, Iran, Somalia. Now the president is talking about Colombia. He says Cuba is just going to basically maybe fall on its own. And then he said, of course, we need Greenland in an interview with The Atlantic over the weekend. So potentially everyone is questioning, is this a harbinger for more muscular, aggressive foreign policy in Trump in 2026?
We talked about it at the top of the hour, just how transparent they've been about this, about how refreshingly transparent they've been about this. Typically, governments who have done similar things have dressed it up in different kind of language. They put this in the national security strategy. Back in November of last year, the United States will reassert and enforce the Monroe Doctrine to restore American preeminence in the Western Hemisphere. It went on to say in that paragraph, we will deny non-hemispheric competitors the ability to own or control strategically vital assets in our hemisphere.
Calling it the Trump corollary. Basically, they're saying this is a common sense and potent restoration of American power, priorities, and consistent with American security interests, a.k.a. we need natural resources, and they have been honest that they are over years of Russia, Iran, China, at their doorstep, and they want to push that back. They view the Western Hemisphere that the United States needs to take a more aggressive role.
What could this mean for the broader FX market? Let's turn to the US dollar. The greenback risking or rising to a 2-week high after posting its steepest annual decline since 2017. Jyoti Banawach of TD Securities writing, we have an off-consensus call for another collapse in the US dollar by the middle of 2026. Jyoti joins us now for more. Jyoti, good morning.
Thank you so much.
Can I just deal with that word collapse? How would you define collapse? Because we might get some pushback this morning to that word.
I think you need to draw a line between short-term moves and more significant moves. I think when I mean a collapse, I mean something similar to what you saw in Q2 of last year, which is you saw a massive move lower in the US dollar, which came from a bunch of things coming true. The US was no longer growing as strongly as other countries were. The growth differential between the US and the rest of the world collapsed at a time when the American policy was injecting volatility into global markets and questioning the use of the dollar as a safe haven. We think that that kind of a trend will continue this year, where people will continue to question if the dollar is really a safe haven or not, because the list of risk events in the US is endless. We've seen that over the weekend, and there's a list of Supreme Court decisions still pending.
Can we just get into what we saw in FX? So we saw a close to 10% move in the dollar index, DXY.
Yeah.
What we didn't see was a sell-off in the broader bond market. In fact, there was a risk back in April. Certainly we had a broader conversation around this table about that. People would sell the dollar, they'd sell US fixed income. Didn't happen.
Yeah.
What does that speak to?
So I think what you mentioned, a few minutes ago, was that the Sell America theme was basically not seen in the bond market at all, but it was clearly seen in FX markets and in precious metals. I think one link which people miss is that the dominance of, let's say, the US in the world has not only just been through the bond market, but actually a more closer link to FX is through the equity markets, where every foreign investor in the world has been blindly invested into US assets, and that too unhedged. So when people do that, they're implicitly long the US dollar. So that's the safety haven of the US dollar, which shifted, where people at times still want to hold US assets, particularly because of AI, but they no longer want to hold it unhedged, which means that, if I were to just put this into numbers, foreign investors hold 33 trillion in US assets. Even if I were to assume a marginal increase in their hedge ratio of 10%, that's 3 trillion of dollars selling. That's potentially, that happened in markets, and a lot of it is still left to come this year.
We've seen U.S. policy take this approach, though. 36 years ago to the day, this happened basically in Panama with their leader. What makes this different right now?
I think this is clearly a very different shift from the kind of, let's say, the democratic regime or the last decade of, policymakers we've seen in markets, because this is a very head-on approach to global dominance, not just in AI, natural resources, global stockpiling of those, and also, curtailing threats to, let's say, the bigger pieces of Russia and China. This is a very active injecting of the US in foreign policy everywhere, and, they're not being discreet about it. As you mentioned, they were very explicit about it in November last year. So while all of that's great, that can potentially shore up US interests, the US will remain the super driver of the next productivity cycle in the world. I think that's great. The dollar will likely remain overvalued in the long term, but unfortunately, I don't think that prevents the dollar's collapse in the short term. That's not going to prevent the Fed from cutting interest rates. That's not going to prevent the labor market from weakening. Your payroll reports this week is not going to move from any of this. Long term, yes, but this year, I don't think it's going to impact.
How much is your calls predicated on the fact that we have seen a massive run in precious metals, most notably in gold?
I think that's also the de-dollarization, the loss of the dollar as a safety asset and a safe haven, which has also played into gold markets, which is why gold keeps shooting higher. Even our commodity analysts forecast gold to, easily touch 4,400 and keep shooting higher, because that, safety asset of the dollar will continue to, die down. We still have so many Supreme Court decisions pending on if the Fed will even remain independent, if IEEPA tariffs will remain legal or not, and with the continued wave with which the US is now dominating global uncertainty. Think of all of the global shocks we saw in the last 5 years. The US was this nirvana, safety haven, which was shielded from COVID, supply chain crisis, Russia, Ukraine. But now it's the opposite. The US is now the emanating source of global uncertainty into the world, which is what's playing out in the dollar.
I just want to unpack two things that you mentioned. One was precious metals and the other was Russia-Ukraine. Post-Russia-Ukraine, there was this big push from some questionable countries to diversify their central bank reserves. Have we seen the bulk of that move, or do you think there's more to come?
So that bulk of that move, actually, I think you rightly mentioned, has been happening since Russia-Ukraine, where a lot of the emerging central banks, China notably, has ramped up their holdings of reserves into the gold. That has actually died down, and the move that you saw in gold after that has been more speculative, more leverage funds getting into that move. So that is still happening, but at a reduced pace that it was happening at Russia-Ukraine, which is why we think that the move in gold is now not purely linked to that. But a lot of the retail, speculative, and other market participants joining into that move because of the perception of the US ever since we've had a new person in power.
Just to finish on the year ahead, what kind of regime are we in now? So you talked about growth differentials closing through last year, which drove the bulk of this move, at least in your opinion. What kind of regime is this for 26?
I think 2026 is going to be a year of divergence because in the US, we're still talking about the Fed potentially easing interest rates from here. We think that this year they will cut at least 3 more times, which is something which the markets are not pricing. Whereas other central banks, ECB, RBA, BOC, will start talking about hikes now. Those are countries where the monetary easing has already happened. In fact, that will now play in to cushion those economies and uplift their economic outcomes. Whereas in the US, we'll still be dealing with slowdown, moderation, uncertainty, and Fed easing. So I think this will be a year of divergence.
Dollar index this morning positive by about 0.2%. Jyoti, good to see you. Thanks for dropping by. Jyoti Abramowicz there of TD Securities on the US dollar for the year ahead. Let's get you an update on stories worldwide this morning. Let's cross over to Vonnie Quinn to get your Bloomberg brief. Hey, Vonnie.
Hey, John. Thank you. Ukraine President Volodymyr Zelensky says US negotiators will join European leaders in Paris tomorrow to discuss post-war security guarantees for his country. The talks will be held with hopes of setting up a meeting in the US by the end of January. The White House hasn't commented on US participation in the talks. OPEC Plus sticking with plans to hold supply increases in the first quarter. This as members await clarity on how Venezuelan President Maduro's capture impacts supplies while facing a surplus. The next OPEC Plus meeting is set for February 1st. U.S. airlines are restarting their Caribbean operations after the U.S. strike on Venezuela, which triggered airspace closures across the region. Vacation hotspots such as Barbados, Aruba and Puerto Rico saw hundreds of flights cancelled, stranding thousands of passengers. The airlines say it'll take a few days to fully stabilise their networks. And that is your Bloomberg brief. John.
Getting stranded in St. Barts doesn't sound too bad, does it, Vonnie? You know, to start the new year.
And individuals were having stranded parties, extending the partying in all these places. And I know a couple people that were stuck in the Caribbean.
There you go. Some very small violins this morning, at least. Up next on the programme, new year, new Fed chair.
I know within 3 or 4 people who I'm going to pick. I know who I'm going to pick. Yeah.
Ooh, tell us. Kevin Hassett.
I'm not telling you. Someone who believes in lower interest rates by a lot. I'll announce them at the right time. There's plenty of time.
Up next, we'll catch up with Krishna Gua of Evercore, live from New York City. You're watching Bloomberg TV. Kicking off the first full trading week of 2026 with futures higher by 1/3 on the S&P 500, on the Nasdaq up by 0.75%. On the S&P, the average forecast on the street, the average guesstimate 75.55, the high is 8,100. John Stolfus over at Oppenheimer, the low 7K. Just a little north of where we are at the moment. Stifel's Barry Bannister looking for 7,000 on the S&P. One of the most accurate forecasters for the S&P 500 last year, Chris Harvey. Chris Harvey put in about 7K for last year at the very start of 25 and came very close to that number. We'll catch up with Chris in a few hours' time. If you're just catching up with us and you're looking for some price action, you're probably starting in the commodity market. You're not seeing big moves this morning in crude, on WTI or in Brent. WTI crude 57.73 up by about 0.7%. Where you are seeing a bigger move is at the single name level in the energy sector. Chevron up by 7.5%. That company in focus this morning.
They have a special license. They're the only U.S. major oil producer still in Venezuela. They account for 25% of the nation's output. Chevron and its CEO, Mike Wirth, are the individuals to watch in terms of how potentially you could see an expansion of U.S. interest in Venezuela. I spoke to Mike Wirth in November, and he said this: we play a long game.
167.53 in the pre-market. More on that company later on this morning. Under surveillance this morning, new year, new Fed chair.
I know within 3 or 4 people who are going to pick. I am looking at Kevin also. Secretary Scott Bessent. We're thinking about him for the Fed, but he wants no part of it. I know who I'm going to pick. Yeah.
Who tell us? Kevin Hassett.
I'm not telling you. I guess a potential Fed chair is here, too. I don't know. Are we allowed to say that? Potential. He's a respected person, that I can tell you. Thank you, Kevin. We're going to be looking at a couple of different people, but I have a pretty good idea who I want. Someone who believes in lower interest rates by a lot. I'll announce him at the right time. There's plenty of time.
So here's the latest this morning. Investors are awaiting President Donald Trump's pick to lead the Federal Reserve. The president saying he would announce the next chair sometime this month. Joining us now is Krishna Guha of Evercore ISI. Krishna, we can get to consequences and your thoughts, your base case, baseline views for 26. But have you got a best case guess at the moment over who's going to be the next Fed chair?
Look, I don't have an inside track on the mind of President Trump. It does seem from the reporting that the two Kevins, Hassett and Warsh, are in pole position. For a long while, as you know, the focus was very much on Kevin Hassett, but some recent music around Warsh put him back up in the betting odds. That seems reasonable to me. I guess Hassett's still perhaps a bit more likely than Warsh, but those two, I think, they're leading the pack at this moment.
Krishna, you heard the language of the president in his own words, someone who believes in lower interest rates by a lot. What do you think the outcome of all of this is going to be for the rest of the committee? Do you think this could lead to a new, noisier dovish core, but a less effective dovish core?
I think the right way to think about it is that monetary policy in the US this year, from June onwards, when the new chair comes in, is going to be a multi-round negotiated compromise between the new chair and his allies and the old committee that he inherits from Powell. The old committee gave us its opening bid in the December SEP, median of just one cut in 2026, although actually a large group seeing 2 cuts, possibly more. I think when you look at what the new chair is going to come in thinking and saying, he's going to be pitching somewhere between 3 and 5 cuts. So where's it going to trade? The answer is it's going to trade somewhere in between. We think 3 cuts this year is the best guess right now.
Do you think that's enough to anchor inflation expectations, Krishna?
So I think that we're looking at a world where the Powell Fed, if Powell continued in office, would probably be cutting 2 times this year. I think under the new chair, we'll probably get 3. Now, the question is, do you think that Fed credibility or independence turns on the difference between 2 or 3 cuts? I don't, personally. I have a view of the economy where I think productivity is going to be good. I think unit labor costs, wages minus productivity are going to be soft. Expectations well-behaved, shelter inflation well-behaved. So I think that 3 cuts is something that the bond market would be okay to go along with, even though it's expecting more like 2 right now. And I think the equity market would love it. But you're absolutely right that if the new chair overdoes it, looks like the reaction function is lurching for political reasons, not because of good productivity or softer, unit labor costs, then you run a real risk that the bond market at some point could throw a riot.
Well, Krishna, to that point, in early December, the Financial Times had a story about bond investors warning the Treasury Department about picking Kevin Hassett. Do you think we can actually see the bond market push back at a Hassett Fed chair?
So first of all, I do take some of those reports seriously, but with a pinch of salt, in the sense that I think there's quite a lot of evidence that there's lobbying going on around the different candidates, and folks in financial markets and elsewhere who have a preferred candidate, trying to sort of lean in on that before the decision is finally locked. And that's something you might see with a number of different senior appointments. I think it is true that there is probably a bit more unease in markets around Hassett as a less well-known quantity than Warsh, who, of course, we know as a former Fed governor. So certainly, depending on who the pick is, and in particular how that person comes out the gates, what they say, do they strike the right notes on being technocratic, on being independent, on preserving Fed credibility, on recognizing that it's Fed credibility that helps keep longer-term interest rates low for the benefit of the economy, and therefore also for the benefit of the president. Do they come out the gates in the right way? If not, certainly the bond market could start to push back a bit. But my view is that we are unlikely to see a full-blown bond market riot preemptively out of speculation as to what might happen, I think that would require some kind of clear, coordinating proof point that the Fed was indeed losing its independence and technocratic character. I think absent that, the bond market will be wary, but will not want to trade in a big way.
Krishna, who was your dark horse candidate?
Well, I've always wondered whether at some juncture Secretary Bessent can be persuaded by President Trump to take this gig. We've heard, as your clip reminded us, President Trump on more than one occasion suggests that he actually thinks the best guy for the job would be Scott. Now, Scott seems to have indicated very clearly he doesn't want the job, and obviously he's got a lot on his plate as Treasury Secretary, which actually right now is in many ways a more consequential position than the position of Fed chair. So I'm assuming that Scott sticks to his position, that he doesn't want the job. But were he to have a last-minute change of heart, I still think we could end up there.
These are questions we should be asking Anne-Marie, Krishna. I'll do it for you. AMH, talk to me about why this has taken so long. I thought we'd find out in fall, turn into winter. I thought it might be the end of 25. It's rolled into 26. What's taking so long?
In April, I sat down with the Treasury Secretary, said we'll have a name by the fall. I think partially the Fed is moving towards what Trump wants to see. We had 3 interest rate cuts by the end of the year. I think also they are weighing their options, or potentially Trump is trying to just wear the Treasury Secretary down, where he finally says, yes, I'm going to take it. I asked Trump about the Fed in November, and he looked at Bessent and said, well, I have someone I would like, but, he wants to stay at his current post.
We might have to wait a while for this one, Krishna. We've got to only wait a few days to get a jobs report, so let's finish on that. Median estimate in our survey is 59K. Big range, the high is 155, the low on my screen is 25,000 in our survey at least. Krishna, what are you expecting this coming Friday? And are you expecting unemployment, which is now broken out through 4.5%, to carry on going towards, say, 5 and maybe north of that level?
So I'm not expecting that unemployment is going to continue to drive higher on a consistent basis over the first half of this year. But obviously, that's the key question. That's the question the Fed's going to be very focused on. Therefore, that's really going to be the single most important driver of whether we get any more cuts over the next several months. In my base case, I have more cuts in the market over the year as a whole, but my cuts skew later from June onwards. And that's because my best guess is that we're going to start to see some signs of the labor market stabilizing over the next several months, which in a context where we're getting fiscal stimulus from tax refunds and inflation is peaking in Q1, would allow the Fed to just wait a little longer, wait for that June meeting under the new leader. In terms of the most imminent data, the data for December, what the Fed will be looking for here, what I'm looking for, is signs that the labor market is bouncing back from the pothole around the shutdown and the lagged Doge layoffs in October, November. Providing we see directionally things are rebounding some, I think the Fed can then kick the can to March and see what the world looks like then.
Krishna, appreciate the update. We'll catch up with you again soon, I'm sure. Krishna Guha there of Evercore. We hope he's right. That unemployment situation has got to reverse for the good of this economy. Up next on the programme, Ed Yardeni of Yardeni Research, Norman Rule of CSIS, Bob McNally of Rapid Energy Advisors, and Jim Bianco of Bianco Research. From New York City, the second hour of Bloomberg Surveillance. Up next.
You're continuing to see actually probably an acceleration in this K-shaped economic behavior.
We have ongoing softness in the labor market. Our own forecast, official forecast, has the labor market looking quite resilient in 2026.
I wouldn't read into the unemployment rate ticking up in the most recent print.
The Fed is going to take that increase in the unemployment rate much more seriously than bond markets seem to be right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures pushing higher on the S&P 500, higher by 0.33%. On the Nasdaq, up by 0.74%. Following the stunning developments in Venezuela over the weekend, the price action in the energy market looks like this, very muted. WTI up by 0.5%, Brent crude up by 0.4%. We weren't looking for big moves here. This is where we were looking for a move, and we got one. Check out the majors in the pre-market. Chevron up by close to 7%.
Chevron's the one to watch. They have been in the country for 100 years. They're the only U.S. oil company left in the country. They have a special license. I spoke to Mike Wirth in November, and he says we play the long game, and if things change, we want to continue working in Venezuela. The question is whether or not ExxonMobil, ConocoPhillips decide to go back in. They left in 2007 when Hugo Chavez nationalized their assets. Do they want to go back in when you have WTI trading below $60 a barrel? What is the risk reward? Wouldn't you rather potentially maybe go to Canada for that same sour crude, or just go for more fracking?
This is not a headline price story. This is going to take decades potentially to play out. You know well, we all know about the reserves in Venezuela, but that industry has been plagued by underinvestment now for decades. It takes time to scale up production, even to get back to something close to north of 1 million barrels a day.
Absolutely. It has been mismanaged. You have basic operations that have basically been put on the back burner for decades. They don't have the fresh new equipment. And also, who is really there in terms of industry experts besides PDVSA and Chevron? So this is going to take decades. You have experts saying this would mean basically $10 billion a year for each oil industry major to have to go in and invest to do that. That is why you also have potentially some people saying, we understand the president has said a dozen times talking about Venezuela, it wasn't just about drugs. He says this is also about oil. But people are scratching their heads saying, well, what's the timeline? It's not going to be a year. This is decades out.
Washington, of course, will interrogate the rationale for all of this. Foreign diplomats will have their views as well. Can we just talk about how impressively clean this operation was over the weekend? Something that could have been incredibly messy was impressively clean.
There's been a number of impressive, aggressive approaches we've seen, but impressive when it comes to the U.S. military. Delta Force going in there. There was not a single casualty on the American side. And where Maduro was sleeping was a government compound, and they were able to extract him and his wife and bring him back to New York within hours. He is now sitting 10, 12 miles away from where we are right now in a Brooklyn jail. Also very impressive from the U.S. military were the strikes in June on the Iranian nuclear facility.
Much more still to come on this story, of course, through the next 2 hours or so. So far this morning, equity futures still positive by 0.3%. Coming up over the next 60 minutes, we'll catch up with Ed Yardeni of Yardeni Research, forecasting a bull market that's built to last. We'll speak to the former senior U.S. intelligence official Norman Rule as President Trump doubles down on claims America will run Venezuela. And Bob McNally of Rapid Energy Group as the plan to unlock Venezuela's oil supply begins to unfold. We begin this hour with stocks holding near all-time highs. Ed Yardeni of Yardeni Research setting a year-end S&P target of 7,700 and a decade-end target of 10K. He writes this bull market could be one of the longer ones. Ed joins us now for more. Ed, good morning.
Good morning.
Let's just start with the longevity of this thing. Already several years into it. Why do you think this can take another leg and another leg higher after that?
Well, I think the economy has demonstrated its resilience over the past few years. I mean, all the shocks that have hit it, starting with the pandemic and then the tariffs most recently, and yet real GDP is at an all-time record high. And so I'm just extrapolating that continues, that the economy will continue to grow through the end of the decade, and that by the end of the decade, we could very well see the market anticipating something like $500 a share for the S&P 500, put a 20 multiple on it, and you get 10,000.
Certain things happened last year that people thought would be relevant and turned out to be irrelevant. I'm thinking of the tariffs of April of last year, irrelevant to the headline S&P 500 index at least. And then later on and through the year, the fact that unemployment carried on climbing and it didn't seem to disrupt this equity market. Is that going to be the story for 26 as well?
Yeah, absolutely. And I think 2025 demonstrated that the economy could grow even when we have a labor market that's not growing much at all. And that can only happen if productivity is booming. And productivity growth during the first half of the decade kind of recovered. It was really quite depressed at the beginning of the decade. It's recovered to kind of its annual average of about 2%. I think we're heading to 3%. And going from 2 to 3% doesn't seem like a lot, but it is a lot when it comes to real GDP and keeping a lid on inflation.
Ed, you know better than most what often happens coming into the new year. People look for the other thing. Not the thing that's been working for years, but they look for the other thing. Is it time to move away from tech and get to the other thing?
Well, I'm in that camp. I'm in the notion that it's time to rebalance them. I mean, when you've got information technology and communication services accounting for 45% of the market cap of the S&P 500. Maybe it's time to rebalance a bit. And I've been recommending also overweighting financials and industrials. And now I would continue to overweight them and put some money also on an overweight basis into healthcare. Look, I think every company is basically turning to be a technology company. You either make it or you use it. And so I am kind of keen on the impressive 493. Everybody's focusing on the Magnificent Seven. But I don't know about you. I'm getting AI fatigue. I'm a little tired of the whole thesis here. And I think the market's starting to show that as well. And the 493 are looking more interesting because they'll be the ones that are using the technology to increase productivity and earnings.
Last year, there was a big overhang on questions of how tariffs would impact companies and thus their share price. What do you think is going to be the big policy question mark of this year?
Well, I think everybody's focusing on the fiscal stimulus that's kind of locked into the system with the One Big Beautiful Bill Act that was passed last July, but it was retroactive to the beginning of last year. And so, according to Secretary of Treasury Bessent, a lot of households are going to get an extra $1,000 to $2,000 in refunds more than would otherwise have been the case, and that could be very stimulative. We already have very stimulative monetary policy. The Fed's cut the Fed funds rate by 175 basis points since 2023, and so I think the policies are kind of locked in. And the question is what kind of impact they'll have on the economy. Obviously, a positive one, but the big question is, what about inflation?
Well, given they're locked in, do you think consumers already preemptively spent those checks they're about to get?
I don't think so. I think they're going to be pleasantly surprised by the refunds. I mean, claiming your refunds is not something that's easily to predict. So I do think there's going to be a stimulus from it.
Where do you think this will leave the Federal Reserve and policy for the year ahead?
Well, we've got a lot of known unknowns. We'll see who the next Fed chair is, but we also know that whoever is the Fed chair, it's only really one vote on the FOMC. So the Fed's going to remain data dependent. And I think that with the economy likely to be quite strong, at least in the first half of the year, I think the Fed's done, at least for the next 6 months. One
man, one vote is not how we've been thinking about the Federal Reserve over previous leaderships and previous administrations. Why is it changing?
Well, the previous Fed chairs were consensus builders. That's what they spent a lot of time doing, and they was very successful at it. Particularly Fed Chair Powell was a great consensus builder. But I think the next Fed chair is going to be much more aligned with the president, with the White House, and I think there could be a lot. I think there could be a lot more independence among the Fed committee members.
Is that the unintended consequence of this push by President Trump?
Yeah, I mean, everybody's been talking about the Fed's going to be less independent. I think they'll be more independent. I think you'll see more dissension.
You mean they're going to be more independent because it's so obvious potentially the Fed chair is so tethered to the president? Everyone else will feel like they can be honest and speak out?
Yeah, well, if you got a Fed chair that's Trump dependent and everybody else is data dependent, I think you're going to have a difference of opinion. And it's going to be pretty visible, as it has been in the last minutes.
When you say that they only have one vote, do you think this administration might take a different approach when I think about the Fed and potentially elevate a Governor Waller so they get an extra seat because it is a deliberative body?
Well, I think Waller makes the most sense because he's got the experience, he knows all the players, and he could be more of a consensus builder than somebody that's just kind of a new figure at the Fed. I think whoever is the next Fed chair, they're going to realize they have a consensus problem and they have to deal with it. And so I think at the end of the day, the Fed's isn't going to be much different than what it is right now. Even if the president continues to demand that the Fed funds rate be brought down to 1%, it's just not going to happen if the economy is doing well and if inflation's still kind of stuck around 3% rather than down to 2%.
We hope the economy is doing well in the year ahead and beyond. Ed Yardeni, good to see you. Thank you, sir.
Thank you.
Ed Yardeni of Yardeni Research, who about 6 years ago talked about the roaring 20s, and I can't believe we're already halfway through.
Yeah, we're halfway through the roaring 20s. I think it is important to note, and he wrote about this in his piece, about really that K-shape, though. That's the top end that is really roaring in the 20s, because they have this exposure to the equity market, which was a bull market. But if you're just living paycheck to paycheck, which we see in polls talking about affordability, and you're not exposed to the stock market, it hasn't been that great for you.
That's where the political tension lives at the moment. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Let's cross back over to Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Nicolas Maduro and his wife are being held at a metropolitan detention center in Brooklyn, awaiting a court appearance this afternoon. The Justice Department unsealing an indictment against them, alleging they illegally enriched themselves as they conspired to flood the United States with cocaine. Saks is in talks for a $1 billion bankruptcy loan to keep the business running as part of its Chapter 11 bankruptcy filing that could happen in a matter of weeks. Sources telling us here at Bloomberg the luxury retailer skipped an interest payment in December and has been negotiating forbearance with some creditors. First Buddy might be back. President Trump praising Tesla CEO Elon Musk after a dinner over the weekend, saying he's, quote, 80% super genius and 20% he makes mistakes. This all as Musk posted a photo of the pair and the First Lady, and it comes after months of cooling relations between Trump and Musk. And that is your Bloomberg Brief, John.
Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, Mixed Messages.
Mr. Secretary, who is in charge? Are you running Venezuela right now?
Yeah, I mean, I keep people, fixating on that. Here's the bottom line on it is we expect to see changes in Venezuela.
We're in charge. We have to do one thing in Venezuela, bring it back.
How busy is Secretary Rubio right now? How many jobs does he have?
I believe he has 3, and potentially there's lots of memes on Twitter that he's going to be like the governor of Venezuela or the governor of Cuba, so maybe his portfolio is expanding every minute.
The influence of Floridian politics on the policy of this administration is pretty impressive, isn't it?
From Chief of Staff to Secretary of State, yes, very impressive.
Seeing it in policy over the weekend. Up next, we'll catch up with the former senior U.S. intelligence official Norman Rule from New York City this morning. Good morning. I believe that fellow journalist Sam Rowe put out on X about a year ago, get ready to work every single weekend for the next 4 years. And this weekend was no different. If you were looking for a quiet start to 26, just get into the rhythm of the working day, not happening. Futures positive by a third of 1% on the S&P, on the Nasdaq up by 0.7. On the Russell so far this morning, positive by 0.1. Under surveillance this morning, mixed messages.
Mr. Secretary, who is in charge? Are you running Venezuela right now?
Yeah, I mean, I keep people, fixating on that. Here's the bottom line on it is we expect to see changes in Venezuela. Changes of all kinds, long-term, short-term. We'd love to see all kinds of changes. But the most immediate changes are the ones that are in the national interest of the United States.
We're in charge. We have to do one thing in Venezuela, bring it back.
So here's the latest this morning. Secretary of State Marco Rubio saying the U.S. won't govern Venezuela, even as President Donald Trump doubles down on his claim that America will run the country until there is a proper transition of power. Your team coverage starts right now with Bloomberg's Mika Soner in Washington, Miles Miller outside the courthouse in Lower Manhattan. Miles, can you just frame the moment? What's going on behind you? Just the stunning developments over the weekend and the very fact that Maduro is here in New York City.
Yeah, Nicolas Maduro has just been put into a Bearcat. He'll make his way to a helicopter that'll take him past the Statue of Liberty to the Wall Street helipad and then motorcaded here where he'll face a judge at 12 this afternoon. Let's talk about the stark contrast, right? He woke up this morning at the Metropolitan Detention Center, a facility that has been laden with rats. They said that there was really bad conditions of the food there. He was at Miraflores Palace, a Baroque mansion in Venezuela, just about 48 hours, 72 hours time ago. But they are laying out quite the case against him. They are alleging that back in 2000, when he was a member of the Venezuelan National Assembly, during those years, he was moving loads of cocaine under the protection of Venezuelan law enforcement. If that's not enough, they say between 2006 and about 10 years after that time, he and his wife worked together to get diplomatic passports for drug dealers to be able to move cocaine and other drugs from Mexico into Venezuela, and these charges face the possibility of life in prison. It's possible that the Sinaloa cartel leader, El Chapo, a person who was responsible for moving so many drugs into the United States, may be at the same prison where Maduro could wind up if he's convicted.
We've got Mika Solna down in Washington, D.C. Mika, given the events over the weekend and what Miles just described, take the temperature of Congress from both Democrats and Republicans. What are they saying now?
Yeah, it's really interesting to see this play out on Capitol Hill. I mean, this is clearly falling mostly on party lines. Trump is set to brief House Republicans in a closed-door meeting tomorrow in Washington. So I think we'll get some more reaction out of that. But right now, a lot of Republicans even have questions in terms of what's coming next and who's actually going to be in charge of Venezuela. There's been some skepticism raised on who's actually in charge. Is the U.S., what is the U.S.'s role is going to be, and how Maduro's deputy is going to play a role here, and if she's going to work with the United States.
Mika Solna with the latest down in Washington, D.C. to Miles Miller. Thank you, sir. To the both of you, thank you very much. Kind of inevitable, the reactions we got over the weekend. I think you have to remember successive governments across both parties both had the same opinion of this leader in Venezuela.
Oh, yes, definitely. And there was a bounty on his head under the Biden administration. And when it comes to this indictment, this was from 2020. A lot of questions are going to be asked on Capitol Hill tonight. 5:30 p.m., Hegseth, Rubio, Ratcliffe, General Kane will all be facing lawmakers this evening.
Let's extend the conversation. The former senior U.S. intelligence official Norman Rule writing the following. In addition to ensuring U.S. influence over Venezuela's oil reserves, the administration will seek to reduce China's political influence over a region. Norm joined us now for more. Norm, welcome. We talked about how impressively clean this operation was over the weekend. Given your experience, given historic examples of similar events, what was your reaction to what took place?
Extraordinary display of the skill of U.S. military and intelligence officials working together for many months and then putting an amazing array of U.S. military and intelligence operatives together on the ground. But it also showed the extraordinary nature of U.S. technology. The Venezuelans talked about having air defenses that could spot stealth fighters, and the United States managed to put not only dozens of aircraft but helicopters throughout Venezuela's skies, and Venezuela's air defense was not able to pick it up. Now put that in context of the U.S. military technology being used by Israel and the United States and Iran just a few months ago against Russian and Iranian technology in Iran, and you really get a picture of the extraordinary capacity for U.S. military technology, personnel, and intelligence capability with our partners worldwide. It's quite a picture for our adversaries and partners.
Iran was the big focus in June. Obviously, Venezuela is the big focus now. Norm, what country could be next where the U.S. has a more aggressive foreign policy?
I think it's important to take a real hard look at the December national security strategy, because the national security strategy makes clear that the United States will be inclined to be non-interventionist, but use robust military and economic force, most likely in the Western Hemisphere, and then otherwise use economic and military tools only when needed outside of that environment for limited purposes, not state building, not to put new governments in place. And I think that template has been consistent for the administration throughout the previous year, and I think in 2026 as well. So I think the Western Hemisphere is likely to remain the administration's focus, but the Iranians have been put on notice. There has been some additional social media activity by the administration, and but if military activity were undertaken by the administration, it would likely be limited. This is not an administration looking to involve the U.S. in a conventional conflict.
When it comes to Venezuela and now the acting president of Delcy Rodriguez, given the fact that she was the number 2, her brother runs the National Assembly, she was by the Panamanian leader said this is Maduroism without Maduro. Is this regime containment instead of change?
Well, I think you've got a couple of different issues here. So the U.S. posture, again, is being clarified as interest-driven statecraft. We're interested in stopping drugs, migration, adversary exclusion from oil. Democracy restoration is being positioned as a downstream objective. Now, let's put this in the context as the Venezuelans. They've just seen an extraordinary display of U.S. power. They cannot compete with this. They have no allies of any consequence. So they're going to try to do several things. First, they need to buy time. They need to sustain internal cohesion. They need to delegitimize any potential successor. And they need to then think about how do they manage this environment while Congress, the rest of the world, puts themselves together against the Trump administration, and then seek out maybe overtures for a negotiated coexistence with the Trump administration, if only to prevent follow-on strikes and to maximize their influence in any possible ongoing transition.
Norman, we're tracking live pictures of the former Venezuelan leader heading to a court here in New York City, which is stunning in and of itself. In an ideal world, Norm, this is what people would like to see. They would have liked to have seen this guy step down a long time ago. And then the Nobel Prize winner walks into Caracas the following day to streets celebrating her arrival, and she takes over and democracy reigns. Norm, that's not the real world. Could you share with us the cold, hard reality of the real world and how difficult it will be to engage the resistance that hasn't yet shown itself yet in Venezuela, but could manifest, materialize in the months to come?
Well, to be clear, I'm not a Venezuelan domestic political expert, but for the Venezuelan opposition to take charge, they're going to have to overcome the architecture of the military, the security forces, the Cuban security forces who are ingrained within the architecture of the Venezuelan government, the entire political system of Venezuela, which will be among the first to be put on trial. I mean, the Venezuelan interior minister and the new president will be among the first to be put on trial for corruption and human rights. So they're going to need a safe haven, a amnesty. This is an awful lot to ask for. So the president was not out of his lane to say that it's going to be a tough road to hoe for the incoming president to just step in. And I think for this reason, the Secretary of State was also accurate to describe this as a process. But in any case, this is a situation in motion.
Norman Rule, thank you, sir. We appreciate it. The former senior U.S. intelligence official, just to build on that, it's not just an event framed as one over the weekend, but it's the start of a much longer, potentially messier process.
Yeah, it's a situation in motion. I love what Norm said there, because it is. This is a transformational moment, but it's going to take a very long time to get to the outcome that many people ultimately would want to see. But already over the weekend, after Trump was saying, we've spoken to Delcy Rodriguez, she denounced the raid, called it barbaric. And at the same time, last night, she says we're extending this invitation to the U.S. government to work together on a cooperation agenda. She is seeing the signs on the wall that is up to her, for her to be successful in this new world order via the Trump administration, that she does give a little bit of an olive branch.
We're going to go to a commercial break in just a second, but let's just take a beat. Things you didn't expect to see on the first Monday of 2026. The former Venezuelan leader in a chopper heading towards a court in New York City. Stunning pictures here in Manhattan from New York City this morning. Good morning. Equity futures up again this morning after snapping a 4-day slide in Friday's session. We're up by 1/3% on the S&P, up by 0.7 on the Nasdaq 100, up by about 1/10% on the Russell. Following a really decent year of gains for the Treasury market, yields down to the front end and the long end on 10s as well, down about 40 basis points through last year on a 10-year maturity. We're down another 2 this morning to 416.91. I'm sure you want to take the temperature of the energy market, so let's do that together. WTI and Brent looks like this. in early trading, up by 0.5% on WTI to 57.63. Brent crude, Annmarie, up by 0.4 to about $61.
Well, it's not going to really be a massive move for two reasons. One, what is happening right now in market dynamics. You have a glut for this year, as well as you had WTI down 20% last year. The U.S. is going close to 14 million barrels a day. We are a massive producer. The second hand, if you want to see really an impactful move in the oil market because of Venezuela, it is going to take not even months, years and decades, given this mismanagement that has been in the company. You have companies that haven't been in there since 2007. The only U.S. company left is Chevron, and this morning they are on a tear.
Well, let's talk about Chevron right now. Let's cross over to Danny Berger with your morning movers. Hey, Danny.
Hey, Annmarie is completely right. The move in Chevron has been the standout for the market, John. Shares are up 6.4% in the pre-market. Some of the other oil players, which Annmarie was hinting at, also doing well in today's trade. Exxon, ConocoPhillips, two companies that had been in Venezuela until the mid-2000s when the company's oil patch was nationalized. Those shares up 3% for Exxon, and for ConocoPhillips up more than 5%. Elsewhere this morning, TSMC rallying the ADRs in the U.S. after Goldman Sachs upgraded their 12-month forecast. Shares up 2.5%. They see better earnings. They should rise between 9 and 15% over the next 12 months. They say that their leadership is cemented in AI, and that will help lead them into 2026 and 2027. Finally, rounding off with deal news, I mentioned this in the last hour, some Bloomberg reporting that Apollo and another group of investors would make an investment in QXO of over $1 billion. That deal has become official, an announcement coming out just moments ago. Shares up 4.7%. This is the production company, or rather producing company, led by billionaire Brad Jacobs. John?
Very cool. Danny, thank you. That stock is higher by close to 5% in a pre-market and early trading. On our radar this morning, President Donald Trump warning of a second wave of strikes on Venezuela following the capture of Nicolas Maduro. The president saying the country's acting leader, Delcy Rodriguez, could pay a, quote, very big price if she doesn't do what's right. Elsewhere, Iran's supreme leader vowing to crack down on rioters as deadly protests continue. Ayatollah Ali Khamenei accusing external forces of inciting the unrest, the collapse of Iran's currency sparking the widespread protests. And finally, OPEC Plus planning to pause supply increases in the first quarter as global markets face a surplus. The group looking for clarity on whether the U.S. capture of Venezuelan leader Maduro will impact supply.
So, of course, OPEC is going to be monitoring the situation. We do need to remember that Venezuela only accounts for 800,000 barrels a day. This is very different than the height we've had in the past decades when it comes to Venezuela, almost pushing 4 million barrels a day. And that is the potential now this opens up. What's interesting, of course, for Venezuela is their oil minister is Delcy Rodriguez, who was the former vice president, who is now the acting president. And she was actually at the OPEC seminar in July. So she does know a lot about this industry, and she has all of the connections around the world, especially in places like Russia.
So before we start making jokes about Secretary Rubio turning up in Vienna for OPEC meetings, just how much influence will the U.S. have over what happens with that cartel going forward?
So the United States has always had influence, or you would say maybe a seat at the table when it comes to OPEC. But now the President of the United States is outwardly saying we are running that country. Delcy Rodriguez had a way more friendly tone towards the end of the weekend than she did earlier in the week. You can imagine that they are going to have a lot more say, not just when it comes to Venezuela, but also the fact that the United States has had a very strong relationship with Saudi Arabia, which is really the individual, the country that runs this cartel.
Let's stick with the energy market. The U.S., of course, ready to use the commodity for leverage in Venezuela.
There's a quarantine right now in which sanctioned oil shipments, there's a boat, and that boat is under U.S. sanctions. We go get a court order, we will seize it. That remains in place. And that's a tremendous amount of leverage that will continue to be in place until we see changes, not just further the national interest of the United States, which is number one, but also that lead to a better future for the people of Venezuela.
Bob McNally, the founder and president of Rakuten Energy Group, joins us now for more. Bob, as you and I start this conversation, we're tracking live pictures of the former Venezuelan leader making his way to court here in New York. This is an individual who oversaw the biggest energy reserves on the planet. And this was a sector, an industry in that country plagued by underinvestment. Can you frame for us, Bob, how long it would take to really scale up production in that country now that individual is out of the country?
Hi, Jonathan. Sure. It's a matter of many years to decades and tens of billions of dollars. The good news is, especially U.S. companies, they know how to do it. They have the engineering, logistical, technical expertise, but it's going to take boatloads of money, and we won't be seeing real oil until after the end of the second Trump term. We just need to be realistic about that.
But Bob, is the will there, given the fact that these are companies that had to flee Venezuela in 2007?
Absolutely. They're tantalized, but they are cautiously tantalized. I was in the White House 23 years ago after we were chased out by Hugo Chavez. No fun at all. And they will be very cautious in going back in. But it also gets to this transition. What kind of government are we going to have there? What kind of contract terms? What kind of physical security? There's a wide and deep set of big questions that these oil companies and their boards are going to consider before they rush in. I think it's right that they're up in equity pricing. The market's got this right. It's a nothing burger for short-term crude futures. It's another tailwind for U.S. oil companies' majors coming after this sort of walk back from this peak demand narrative. If you think about it, U.S. oil majors have just had a great extended holiday season. Peak demand is fading in 2030. That's good for them. And now the world's largest oil reserves may be available to them when it really counts after 2030.
Well, you also got it right. I actually thought of you in the morning after this all took place because before the Christmas holidays, you said there was a 70% chance that Maduro would be out. Did you think it was going to happen this quickly?
Yes, we did. I think the market has gotten, you mentioned June in the Iran war. The market doesn't understand Trump. It was surprised when he attacked Iran. It was surprised when he put sanctions on Rosneft and Lukoil in October. And it was surprised when he removed Maduro. I think what the market doesn't understand is the president's willingness to take risk when it comes to confronting adversaries on top-tier foreign policy challenges, even if energy is at stake. And the reason why, Annmarie, and you just mentioned it, the president, the White House believes, and I happen to agree, we're heading into oversupply. He can lean into this softening crude market and take risk, even with Iran and Russia, which are really more important near term than Venezuela.
So what are you telling clients is the next potential risk-taking this administration is going to go for?
Iran and Russia are up next. Look what the president's talking about. Israel is not kidding about preventing Iran from reconstituting its missile and nuclear programs. And with the unrest we're seeing there, maybe stirring the pot. So the president's been talking very forcefully. Look what he said with Prime Minister Netanyahu, willingness to intervene if the regime shoots protesters. I think when the market sort of lifts its gaze from this fascination with Venezuela and realizes there's not a real issue in the short term, it's going to say, wait a minute, how credible is President Trump when it comes to Russia and Iran? With Russia, Putin's not going to agree to armistice. And while President Trump often has a friendly demeanor towards Putin, says nice things, he also tightens sanctions. And I think he's willing to do so even more into next year. So let's look to Iran and Russia for real potential supply disruptions, not Venezuela.
When you say they're up next, Bob, can you just give us detail on what you mean by that? Because up next, after what we saw over the weekend, is a very different scenario for Iran and for Russia. What do you mean by they're up next?
Well, I think if Iran doesn't agree to halt its missile capabilities, its reconstitution, its nuclear capabilities, and if we even see this continued unrest, I think there will be, and we told clients, 70% probability of another wave of at least Israeli strikes on Iran, perhaps supported or joined by the United States. We're at a solid 70% on that. Also, sanctions, tighter sanctions. We've let Iran off. Trump could go to China and say, cut it out. We're serious. Do business with Iran or do business with the United States. So really cutting into their oil exports at least, and military action at best, 70% probability in the coming, let's say, months. Putin, Russia, same thing. So far, they've just wanted to widen the Urals discount to Brent. They just wanted to, hurt Putin's revenue, not cut into production. If oil prices keep falling, it's a big condition. If oil prices keep softening, I think he'll be willing to be tougher on India, China, and other customers of Russia's crude.
Bob, how consistent is that with the national security strategy that they put out at the end of last year?
It is consistent, but it's subtle. You got to read into it. Trump didn't say, look, we're going back to the Western Hemisphere and we're all about not only the Monroe Doctrine, but the Trump corollary, which means we won't even let our adversaries have economic stakes in our region. That's what the focus was. But he didn't say we're completely pulling up stakes in Europe, the Middle East, and Asia. Didn't say that, not acting that way. We don't think China has a free hand in Taiwan. We don't think Putin has a free hand in Ukraine. And in the Middle East, we're going nowhere. So we're kind of having it both ways. I think we're having our internationalism, our global alliances, and the Eurasian landmass on the one hand, but telling the world, yeah, we're really going to be busy in the Western Hemisphere.
Annmarie, that was certainly part of the conversation over the weekend. Does this speak to the idea that maybe they're going to refocus everything on the so-called Western Hemisphere, ultimately Latin America, and take their eye off the ball in places like the Middle East and Europe?
Well, one thing is for sure is that they definitely are monitoring the price of oil. And to Bob's point, does that give them a lot more leverage around the world? Oleg Deripaska actually came out with a telegram over the weekend and was talking about how if the U.S. is able to hold prices near $50 a barrel, that puts serious pressure on Russia's state capitalist economic model. So already this is going to put pressure on all these other countries, even if the administration decides they're just focusing on the Western Hemisphere.
Bob, just before you go, I wanted to carve out some time and talk about a much longer-term issue. The lifespan of shale. How are you considering the lifespan of shale with the developments that we saw took place over the weekend?
Well, we think shale is going to be around forever, and there are other deposits around the world. Look at what Argentina is doing. If the other shale deposits open up, we could see new, strongly emerging shale plays. In the U.S., we think it's a mature sector. We don't see a lot of net growth. But you know what? Look at AI, look at technology gains. Real big mistake to bet against, especially U.S. engineers, U.S. oil geologists, et cetera. And I can see us getting those recoverable reserves up from 10%. We get that up 10% more. I think we could see surprises in our ability to produce oil. But look, it's high cost. It's vulnerable to price swings. It's going to be challenging. It's mature for the time being. So shale is sort of in a plateau for the time being. But if we get a surprise, it's not going to be the death of shale. It's going to be that, wow, we can recover a lot more. We even got more efficient.
Bob, thank you, sir. Let's do it again soon. Rapid Energy Group President Bob McNally there on the developments over the weekend. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Let's cross back over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Thank you. The operators of a Swiss bar where 40 people were killed on New Year's Eve are facing a criminal investigation and possible charges of negligent homicide. The fire, which may have been caused by sparklers igniting the soundproofing insulation, also left 119 people injured. According to multiple reports, the bar in the ski resort of Crans-Montana is owned by a French couple. The Trump administration is taking early steps to reopen the American embassy in Venezuela following the removal of Nicolas Maduro. Sources telling Bloomberg current work is preliminary and no decision has yet been made. The embassy originally suspended operations in 2019, pushing responsibilities to neighboring Colombia. Avatar 3 led the weekend box office, collecting $41 million in North American theaters in its third weekend. Disney's Zootopia 2 remaining at number 2. After 6 weekends of release, the animated sequel has grossed $1.48 billion globally, outperforming Frozen 2 to become Walt Disney Animation's highest-grossing movie of all time. And that is your Bloomberg brief. John.
Vonnie, thank you. More from Vonnie in the next hour. Up next, the flight to safety.
The distribution of risks to the rate outlook is skewed to the downside. You're just going to have a better environment for risk-taking in fixed income, especially in the Treasury market.
Up next, we'll catch up with Jim Bianco of Bianco Research, live from New York City this morning. Good morning. You're watching Bloomberg TV. Set out for the opening bell later on this morning, 9:30 Eastern Time, of course, as we count you down to that. Futures positive by 0.3% on the S&P, on the Nasdaq up by 0.65. Under surveillance this morning, the flight to safety.
The distribution of risks to the rate outlook is skewed to the downside. We do believe it means likely lower rates, steeper curve, lower real rates, higher inflation, lower volatility. All of this points to a very supportive backdrop for activity and continued easing in financial conditions over the course of 2026. You're just going to have a better environment for risk-taking in fixed income, especially in the Treasury market.
Well, here's the latest in the Treasury market so far this morning. Yields falling for the first time in a week on escalating geopolitical tensions. adding to the gains we saw through last year. A 40 basis point move lower on a 10-year maturity. Through the year, this morning we're down to 416.71. To discuss, joining us now is Jim Bianco of Bianco Research. Jim, welcome to the show, sir. The move at the front end, phenomenal, of course, in line with rate reductions at the Federal Reserve. But it wasn't reserved to the front end of the curve. We also saw that rally in the longer end of the curve in a 10-year maturity, bit of leakage in a 30-year. We can get to that in a moment. Jim, what do you think was behind that move, given the Sal America story that really emerged in April, then was very quickly ignored in the back half of the year?
Well, I think we need to first put that in a little bit of perspective. In 2025, all the 10-year yields around the developed world were either unchanged or higher. The only one that was lower was the U.S. All the 30-year yields, not every country has a 30-year, were unchanged to higher, including the U.S. So there was only one long-term yield around the world that went down last year, and that was the U.S. 10-year yield. So something specific to the 10-year yield happened last year. Now, if I had to guess, it's not the GDP numbers, it's not the inflation numbers, because everybody else had very similar, I'm talking about the developed world, had very similar type of numbers, but their yields went up. I think the difference might be political, and that is the president has tied his success to lower 10-year yields and has been demanding that the Federal Reserve cut interest rates. And that had an effect in 2025. Whether it does in 2026 is a different question.
Jim, you're suggesting there is almost an implicit Treasury perk coming from the administration that's making people reluctant to sell that specific maturity.
Yeah, I am, because that specific maturity was the only one that was down. Now, if we had a bunch of them down on yield, like the U.S. Was down 40 basis points in the 10-year, then I would argue to you that, it wasn't. But there was something specific about that maturity. And I don't think that that can last forever. It did last for 2025. So really, it's going to come down to what is the economics of 2026. Now, if it looks like 25, well, we had strong growth. We had a 4.3% GDP in the third quarter, the last number we had. We had inflation that is still in the upper twos. We're almost 6 years past the beginning of COVID, and we're still nowhere near 2%. That those types of numbers will produce higher 10-year yields throughout 2026.
Jim, as you consider the rest of the world, not just the US bond market, but the global bond market, is the center of gravity for US bonds in the US? Or are the dynamics that you're speaking to actually elsewhere? Are they in places like Japan?
Oh, I think you're right that where it's not, if I could talk about the default, is it's not in China anymore. China's now fallen to the third largest country that owns treasuries, behind the UK. And so it has definitely moved to somewhat in Japan, and that is probably a net negative. With their rates going up, the incentive to sell U.S. Fixed income securities and move back to Japan, grows every day. So yes, then by default, it comes back to the U.S. and it comes back to Fed policy, and that comes back to how the growth is. And I'll remind everybody that if you look at the last Fed meeting, it was a 9-3 vote. But if you look at the way that everybody was talking, it might have been 10-9 among the 19 members of the Fed, whether or not they should have cut rates at the December meeting. So if we could continue to get strong growth like this, we might not see another rate cut through 2026.
Do you think 2026 will be risks or opportunities to market participants, especially given the stunning developments just over the weekend when it comes to foreign policy of this administration?
Well, there's always going to be risks, but I guess the real question is, where do the risks come? Do they come in denting growth or slowing down growth, or do they come in potentially pushing up inflation? And I am one that has been and continues to be concerned about inflation. What happened in Venezuela is a good long-term story for crude oil, but it might not even be a 2026 story for crude oil. If anything, it might be somewhat bullish for crude oil over the very short term as they cut off shipments to China that has to replace it by buying it from other places and pushing it up just over the very short term. But longer term, it could be. But I think that most of the risks that I see are going to lead to them to inflation staying in the high twos to the low threes, and the market starting to realize that a 3.5% funds rate and a 4.2% or so 10-year yield might be too low.
When it comes to inflation, what makes you the most nervous? Because many people were talking about tariffs last year, but we haven't seen a real impact on that.
Yet. And the reason I say yet is that while you look at the announced rates that the Trump administration has said about tariffs, it averages about 17 to 18% is what the tariff rate was. A year ago, it was 2. So we went from 2 to 17. But if you look at the actual tariffs collected, It's more around 10%. And I think that accounts for a lot of why you're not seeing the inflation in tariffs, because the collection of those tariffs takes time. But that 10% number has been moving up all year, and it's at its highest level in November, the last data that we have. And I suspect that that number will continue to move up into 2026. And that tariff story about inflation might still be ahead of us, probably around the middle of next year.
Jim, let's finish on the unintended consequences of the president's push for lower interest rates. We spoke to Ed Yardeni earlier on this morning, and he echoed your argument that I want to give you some credit for as well. The fact that this has galvanized every voter on the committee, and it's a change from what we've seen under previous leadership at the Federal Reserve. Jim, can you just spend some time fleshing out what's happening here and why it might be consequential for the year ahead?
For the last 40 years, everybody votes with what the chairman wants. They talk internally, and then they come to an agreement before the meeting, and that's why you get these 12-0, 11-1 votes. But now it looks like the Fed is shifting to be more like the Bank of England or the Bank of Japan, and that is that each voter is going to vote independently, or think the Supreme Court. We saw 9-3. There was a good argument that you could have had a 7-5 vote. I've advocated that that would actually be a positive for the Fed, not a negative. Each governor, each president is supposed to represent the American people and vote the way that they think is the best for monetary policy. And there should be disagreement in that. And if they start to move that way, the biggest thing that could happen is President Trump could put somebody in place. That person could advocate for what President Trump wants, 1% funds, but does he have 7 votes to get it? And he might not have 7 votes to get it in 2026 if the economy stays strong and inflation stays sticky, and that could be a big departure from what we've seen from the Fed in recent decades.
Jim, is that one of the main pillars for your call for this year, that ultimately we don't get much action from the Federal Reserve?
Yeah, I think so. I think there's a lot of people that are thinking 2 or 3 cuts because we're going to get an uber dovish Fed chairman, because Trump is going to replace Jay Powell by May. But again, it really comes down to, yes, in the old way, the chairman would tell everybody how to vote, and they would disagree internally, but they would do what he would want. But in the new way, they might just say, no, you just don't have the votes for it. We're going to vote otherwise on this policy.
Jim, thoughtful. Good to see you. We'll see more of you, no doubt. Jim Bianco there of Bianco Research. This idea that you get a noisier but less effective dovish core at the Federal Reserve.
Well, this is why so many people say just elevate Governor Waller. One, the market will view him as credible. 2, he actually is an individual that could potentially change votes, could potentially take a hawk and say, let's get one more interest rate cut. We basically saw him maybe push Powell in that direction, given the Jackson Hole speech. So that is why so many people say it's a deliberative body. Play the smart musical chairs, elevate Waller, get another vote on someone else you could put in there. But I don't know. It sounds like they might pick one of the Kevin.
It's certainly taken longer than we thought it would. That's for sure. Up next on the programme, we'll catch up with Chris Harvey of CIBC, Dan Pickering of Pickering Energy Partners, Aditya Bave of Bank of America, and Gil Luria of D.A. Davidson. The third hour of Bloomberg Surveillance just around the corner from New York City. You're watching Bloomberg TV.
Respect the trend, but don't ignore the risks as we go into 2026.
Earnings are going to be what drives stock prices.
You're going to see a lot of churning, but have moderate returns.
I still think tech is long-term leadership.
There's a 30% chance that you get a full-on bubble next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. The events over the weekend, shocking for the world of international relations, not for this market. Futures up by 0.3% on the S&P, on the Nasdaq up by 0.7%. The energy market unmoved. Brent and WTI going absolutely nowhere this morning, up by 0.8% on Brent, and both WTI as well. If you want to move, it's in the pre-market. It's the likes of Chevron, one of the rare companies right now that actually still operates in the energy sector in Venezuela. Chevron up by more than 6% so far this morning.
And that's because it has a special license, despite U.S. sanctions, to operate in the country. They have been there for 100 years, and they account for about 25%, Jonathan, of Venezuela's output. When it comes to Exxon, ConocoPhillips, will they actually go back in? A lot of people say yes. But this is going to be billions of dollars. It's going to be years and it's going to be decades. And as you noted earlier, these are companies that got burned in the past. Under Hugo Chavez, when they nationalized these companies and their assets, they all fled. They sued the government, and they only got a fraction back from the Venezuelan government that they actually should have received. So there is going to be a lot of boardroom discussions amongst these oil giants on whether or not they want to go take that risk.
This is a multi-decade story. It's not happening tomorrow. And to take stock of the conversations over the past few hours, this is not a one-off event over the weekend. It's the start of a much, much longer process. At least so far this morning, Chevron's getting some of the gains. If you're looking elsewhere in the bond market, yields are lower across the curve. We've got 2s down a basis point, 10s down by 2. Let's call it 417. This off the back of a big rally last year on both the front end on 2s and further out on 10s as well. Over the last 60 minutes or so, 2 guests on this programme, Ed Giardini, Jim Bianco, making the point that the president's push for lower interest rates is having unintended consequences and galvanising the other votes on the rest of the committee, which offers you a noisier dovish core on the Federal Reserve, but a less effective one. And that's going to be something to watch for the year ahead, with the likes of Jim Bianco saying you probably will get no interest rates for 2026.
Well, Jim Bianco, though, is very concerned and has been when it comes to inflation. But to Ed Giardini's point, which I think was a very good one, if you, and we've heard this as well from other economists, if you have an individual that the market views as basically a puppet of the Trump administration, that galvanizes the other members of the committee to be more outspoken, which in the end maybe makes the Fed more independent, or at least minimum, more transparent.
Nice slow start to 26. Exactly what you were looking for. It's great, isn't it? It's absolutely fantastic. Looking forward to navigating these choppy waters with you through the year ahead. Coming up over the next 60 minutes, we'll catch up with Chris Harvey of CIBC, with stocks edging higher. Dan Pickering of Pickering Energy Partners as Chevron rallies on developments in Venezuela. And Aditya Bhavev, Bank of America Securities, looking ahead to the December payrolls data due this Friday. We begin this hour with stocks rising to kick off the first full trading week of 2026 after nailing his bullish call in 25. Chris Harvey of CIBC is eyeing only modest gains in the new year, saying people are sleeping on a lot of macro risk this year. Chris joins us now for more. Chris, good morning.
Good morning.
Can I give you a ton of credit for your call last year?
Maybe a little bit.
It never changed through April. It just stayed. I never understood what the 007 was about, but it never changed. It was at 7K. You kept it there all year until you left your old shop. Yeah. Congratulations.
Thank you. There was a lot of this too will pass, right? I didn't quite understand why we had seen Trump 1.0, right? 1.2 is Trump is going to go out to the nth degree, and then he'll come back in. And I think people, for some reason, just lost their nerve. And at the end of the day, things that we expected to really help out, deregulation, more M&A activity, tight credit spreads, an easier Fed, were all there. So if you follow the macro, if you follow the fundamentals, it actually wasn't that hard.
Credit to you to looking through the noise, because there was certainly a lot of noise through last year. How is this year going to be different? Just compare the characteristics of last year to your expectations for this year.
I think this year is different for a lot of different reasons. One is many of the things we were talking about last year, people are now talking about today. Hey, margins are going to expand. Hey, the macro trade is really there. Hey, the Fed's going to be easier. Hey, how about taxes? How about deregulation? But the optimism is so much higher. The other issue is, as we said before, we think people are sleeping on the macro risk. And this is a macro risk this weekend or over the last couple of days, a macro risk we didn't even see, right? And so people forget, right, there's been a heck of a return since Liberation Day, and I think people have gotten very, very comfortable and probably a little bit too complacent.
We haven't seen massive market moves, though. So how much really was this weekend a macro risk?
So it's not so much. So when we look at Venezuela, we see an economy that's not very big. We see oil production that's not incredibly important. It's important, but not incredibly important. We see steady production. So it's not a big one, but it shows you that macro risk can come out of the blue. And that you really need to start looking at these things. And the way risk is priced for perfection, right? We get more macro risk like this, it's going to be hard to keep risk priced where it is.
Do investors now think of 2026 in a different light post-Venezuela, as they're now trying to eye where there are other places the U.S. administration may take a more aggressive foreign policy approach?
No, I don't think they think about 26 different because of Venezuela. They are really bulled up, and maybe too much so. Now the question is, what was the main driver? Was it affordability? Was it leverage for this country or that country, for USMCA? Was it the U.S. trying to show power versus the rest of the world? Is it this regional model we're putting a stamp on? We're really trying to figure out what was the major driver and what are the ramifications. A lot of people are talking about, hey, is Venezuela going to be a bigger oil producer or less? we'll leave that for somebody else, but the macro drivers we're really toying with, and it's not clear what the main one was.
Lots of risk manifested and materialized in the last 12 months. Bombed Iran, that was stunning. Right. Saw the April events with the tariffs, that was phenomenal. And then in the early part of last year, we had the DeepSeek shock as well. We got over that pretty quickly. It's identifying the ones that actually matter. Yeah. That seems to be difficult right now. If I'd said to a lot of people where payrolls and unemployment would be through last year, they would have said that would have been maybe a risk for the broader equity market and risk appetite, and it wasn't. What are the risks that matter for this year?
So I think there are a couple. I think the C-suite, after double-digit gains last year, it's prudent to come in this year and manage expectations down, right? You start to manage expectations down, that may take investors by shock. Not shock, but by surprise. Two, I think the Fed is probably a lot less dovish than people think. We may not get a cut with this Powell Fed, right? If you look at what they're saying is, hey, the economy's stronger, inflation's down, we're back to neutral, I'm going fishing, right? And then if you throw in a couple other things, we still have tariffs, but really USMCA is going to be, I think, renegotiated in the first half of this year, and that's not going to be done. I don't think that's going to be a smooth process. Let's just say that.
So, Chris, I'm with you.
Right.
Anne-Marie's with you too. That could be messy.
Right.
But given what we went through in April, why would it matter? We've just had the ultimate stress test of all of that, haven't we? It couldn't be any bigger or any worse than what we saw take place last year, could it?
Well, it's what we started with. Stock prices are a lot higher now than they were back in April.
You think there's less capacity now to absorb bad news?
Valuation is higher. Risk is priced. Credit spreads are less than 80 basis points. If you look at some of the risk measures in the equity market, they've had phenomenal runs. And so expectations, optimism is so much higher this year than last year.
John started this conversation saying you got it right. You have a high pain threshold. Going into 2026, do you have maybe less of a high pain threshold?
It's not so much a pain threshold. It's just I'm looking at things and I just don't see as much opportunity this year. You could have a melt up, sure. But if you look at valuation, you look at opportunities, you look at things that aren't really priced by the marketplace, there's not a ton of them out there.
So I'm going to pick up on the Chris Harvey argument of last year and sort of push back using your own words, your own argument.
Right.
This year, the president has got to look to the midterms.
Right.
It's already made a pivot towards affordability.
Yeah.
You've talked about ultimately just stay in the course, stick with it. We know what the president wants. He doesn't want a bad economy.
No.
He doesn't want to have a bad result in the midterms either for his Republican Party. Why would this year be any different when it comes to those things? Why wouldn't he lean even more into trying to generate these optimal outcomes for the economy and for markets?
Right. So a couple things. One, if you look at what's going to happen with the big, beautiful bill, right? For middle and lower class or lower income folks, I would say your refund's going to be bigger. Your take-home pay is going to be bigger. If you look at what the Fed's doing, they're starting to buy back treasuries. You look at M&A. M&A is good. It's all really positive there, right? But it's also a timing issue. What if the Fed doesn't cut until June? That's not priced in at this point in time, right? What if something out of the blue comes back into the picture, like something bigger than Venezuela, right? And what's the marginal driver to push us higher? There's a lot of gold bulls out there, but one of the things I keep saying is, hey, those marginal drivers, hey, leverage is still there on the sovereign side, but the big, beautiful bill, the fiscal spend in Germany, in Canada, and other places has already occurred, has already been announced. What else is going to drive it there? And I'm just at a loss for those marginal drivers really pushing things beyond where I think they can get.
Is a $2,000 dividend check a marginal driver?
Okay, so that's the question. Is there a $2,000 check, right? Trump, you're right. John's right. They want to win the midterm elections. They're going to do a lot of things on affordability, but how much more can they announce and really do at this point in time, right? And how much does the market push back? And the other thing that was said on the program before, we haven't even talked about incorporating higher rates into equity market prices. What if the 10-year is at 4.5%? We're not really thinking about that, but that's possible. And the other thing we're not talking about is, hey, we could just have event risk, some equity shocks, and we've seen over the last 12 months how that can really upset the apple cart.
You're starting to sound a little bit bearish. What do you do in terms of hedges?
So hedges, if you look at low vol, if you look at high quality, if you look at staples and some other defensive sectors, they're really unloved and underappreciated. That's the market telling you really need to start adding some risk aversion to the portfolio, either with higher quality, low vol, or some of those defensive sectors.
Let's just define what bearish is in 2026. What's the year-end price target?
It's 74.50.
He has a big wall of worry, though.
I hear you, but it kind of speaks to the world we're in, right?
It's
still a grind
It's
up.
going to be a good year, a decent year, but we think there's a lot more volatility. There's going to be bouts of risk aversion. This is not going to be smooth sailing for 12 months of the year.
We've just been spoiled by double-digit gains over the last few years, haven't we?
I think so.
Chris Harvey of CIBC. Chris, it's good to see you.
Good to see you too.
Happy New Year. Thanks for dropping by. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Thank you. The acting vice president of Venezuela, Delcy Rodriguez, asking the U.S. to work with her country as acting president. A sharp turn from her initial statement calling for Maduro's return. President Donald Trump saying some rebuilding will be needed in Venezuela, warning Rodriguez that if she doesn't do what's right, she is going to pay a very big price. U.S. airlines are restarting their Caribbean operations after the U.S. strike on Venezuela triggered airspace closures across the region. Vacation hotspots such as Barbados, Aruba and Puerto Rico saw hundreds of flight cancellations, stranding thousands of passengers. The airlines say it will take 2 to 3 days to fully stabilize their networks. Denmark's leader is warning President Donald Trump to stop threatening to annex Greenland. Mette Frederiksen writing, the U.S. has no right to annex any of the 3 countries of the Kingdom of Denmark. Trump argues the U.S. control of Greenland is necessary for national security and says he'd revisit the issue in 2 months. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thank you very much. Up next, the Morning Calls Plus, Dan Pickering of Pickering Energy Partners as Chevron rallies on developments in Venezuela. That stock is up by 6.3%. Live from New York City, you're watching Bloomberg TV.
There's a wide and deep set of big questions that these oil companies and their boards are going to consider before they rush in. The market's got this right. It's a nothing burger for short-term crude futures. It's another tailwind for U.S. oil companies' majors coming after this sort of walk back from this peak demand narrative.
Bob McNally, absolutely fantastic on the programme earlier, of Rakuten Energy Advisors, of course, weighing in on the stunning developments over the weekend and the capture of the Venezuelan leader, Nicolas Maduro. It's a nothing burger for the headline price, but could be something bigger looking further out.
Looking further out, because you look at the potential Venezuela has. You have historically the biggest proven oil reserves, at least they say, when it comes to what's in the ground. At one point in their history, they were pumping nearly 4 million barrels a day. Right now, it's about 800,000. So you could see the growth potential. The issue is years, decades of underinvestment, mismanagement. Do these companies want to go back into a country that literally seized their assets? That's a question.
Crude so far this morning up by 0.9%. WTI 57.81, Brent 61.19. The broader equity market grinding higher into the opening bout. The cash open about 1 hour and 13 minutes away, higher by 0.25% on the S&P, on the Nasdaq up by 0.7. That's the price action. Let's get you some morning calls. First up, Jeffries downgrading Adobe to hold, noting a lack of AI growth inflection. Your second call from Mizuho, raising its price target on Walmart to 125, seeing the key underpinnings of spending still intact. And finally, Bernstein lowering its price target on ExxonMobil to 137, expecting near-term choppiness in the oil industry. That stock is up high this morning off the back of the developments over the weekend, high by 2.7%. Let's stick with energy. Chevron running in the pre-market trading, with President Donald Trump pledging to revive the Venezuelan energy sector. Dan Pickering of Pickering Energy Partners joins us now for more. Dan, welcome to the programme, sir. If we can just pick out that one name, Chevron, what's their presence like in the country at the moment, and what's this market starting to sniff out?
Sure. Chevron, about 250,000 barrels a day of production in Venezuela, the biggest meaningful external producer in Venezuela. What's the market deciding? They've probably got more opportunities, assuming there's a rule of law and a good government that winds up being in Venezuela. So I think the market says Chevron's got opportunity to grow in Venezuela if the country stabilizes.
We know that the geological risk is very minimal because we know the oil is there. But at this price level, is there a real incentive for these companies like ConocoPhillips, ExxonMobil to go back in?
All a function of the terms that they get. I would assume that, assuming government support from the U.S., that there will be very attractive contracts, and that even at $50 a barrel, there'll be profitability for the folks that come in and invest in Venezuela's oil business. I think we've got to see that develop and understand the actual terms. That's going to take a while. It's going to take 2 or 3 years to really meaningfully move production, because we've got to get the terms, we've got to get the money in the ground, and then get the results.
What about the Chinese players that have been angling to get into Venezuela and that are physically there? Is there going to be a real rush or a fight between China and the United States when it comes to these assets?
Well, I think that it all depends on how aggressive the United States is on trying to, quote unquote, run the country. I think that the U.S. views these assets as something that could be advantageous to us over a period of time, and they're going to try and keep the Chinese out and the U.S. and international oil majors in. So the more significant the U.S. presence, the more likely China's role is minimized. So let's watch and see how President Trump moves ahead with managing Venezuela over the next year.
Dan, I understand we're having a conversation about things deep into the future, but there seems to be a bit of tension between the way people are thinking about the energy market and the way people are thinking about the energy stocks. Dan, given the potential for increased supply, why is any of this going to be good for the Chevrons and Exxons of this world?
Yeah, so I think that there are winners here. If Venezuela opens up, it'll be the companies that go in and can grow either their production, their revenues, if they're oilfield service companies, et cetera. The reality is that another 1 million or 2 million barrels a day from Venezuela long term is an overhang for oil producers. I mean, it's a boon to oil consumers, but I think the market's early reaction here is to pick winners and bid them up, a bit of fear of missing out, given how weak the oil sector's been for the last couple of years in terms of stock market performance. But I think as you move out in time, there will be a sorting out and a realization that this is probably a net negative for oil price and therefore a little bit tougher environment for the oil companies.
If it's a net negative for oil prices, it might be challenging not just for oil companies, but petrostates. Which one around the table at the OPEC Plus meetings is going to potentially suffer from this?
Yeah, I think if you look at OPEC Plus, more production from Venezuela is just another source of supply that they're competing with. Although Venezuela is a member of OPEC, they probably won't be governed by any sort of quota restrictions. So if you look at this, basically oil producers, whether it's Saudi Arabia, Russia, et cetera, all lose a bit on the margin. Again, how quickly can Venezuela add meaningfully to supply? The other issue, U.S. shale starting to mature, some other countries starting to see a rollover in their supply. So over time, are we going to need more barrels from Venezuela and other places? Sure. But in the intermediate term, call it the next 2 to 5 years, all the oil producers lose, including Venezuela's OPEC brethren.
Do you have a line in the sand when you can see potentially Saudi Arabia shifting policy and wanting to take barrels off the market to increase price?
Yeah, it feels like $50, give or take, WTI, maybe a bit lower, high 40s, is the pain point at which the whole industry really starts to feel a lot of significant pressure. And so my guesstimate is that oil moves into the high 40s, $50 a barrel. Everyone's going to be asking, what should we be doing differently? OPEC spent the last year bringing production back. Do they really want to turn it off again? Will U.S. shale start to shrink their investment? Will the majors start to shrink their investment? So I think 50 is this flashpoint. Also remember that we've heard from the U.S. administration, they want 50. So will the U.S. try to strong arm OPEC into keeping prices in that $50 level?
Dan, as we speak to you, there's a word that comes up time and time again, and it's the word time. Every informed guest we've spoken to throughout this morning has used that word. This is going to take time. What's your evaluation of the timeline that we all need to consider for future developments in a place like Venezuela? I talked about sort of this ideal world and the way the media responds to these stories. You're going to get the Nobel Prize winner walks into Caracas, takes over, democracy reigns, and they don't talk about Venezuela ever again. Dan, that's not how this is going to work. Can you share with us how you think this is going to work and your evaluation of the timeline moving forward?
Sure. I think meaningful, call it 500,000 barrels a day of incremental supply, is a 2029 issue. It's going to take 6 months to figure out, literally what's going on in Venezuela, who's in charge, what's the rule of law, what's the backstop from the U.S. government in terms of investments of capital into the Venezuelan oil business. So it's going to take a year to get a system in place to be able to spend money. You'll negotiate with companies during that time period, but you go back into an aging infrastructure. The oil industry was dramatically higher, over the last 25 years, but it's fallen into disrepair. You're going to have to spend money to repair. You're going to have to figure out what's going on. And so commercial arrangements take a year, investments take a year plus, and then you start to see the production in the following years. The other thing is 500,000 barrels a day. That's the easy part because you just kind of rehab existing facilities. Really spending a lot of money and getting production up another 1 million barrels a day probably takes 5 to 10 years. So this is not on TV time. This is on real world time. And so I think 2029 for initial production bump, and then you're talking in the 2030s before it's a meaningful increase beyond maybe 1.5 million barrels.
I'll tell you this on behalf of everyone, Dan. We appreciate the reality check. Thank you, sir. Dan Pickering there of Pickering Energy Partners. This isn't going to happen overnight. You don't just make one move, remove Maduro and move on. You've still got to negotiate existing power structures in the country. Now, you didn't see much resistance over the weekend, but don't just look at that and say there isn't going to be any in the future either. There are still existing power structures that this government has got to deal with. And I think that's why ultimately you see this more pragmatic approach, realistic approach coming from Secretary Rubio over the weekend about what needs to happen, and the first early steps are just the first early steps.
Right. When the president talks about it, he says the oil companies are going right in. But to Dan's point, to yours point, this is going to take years. Not just the power structures, but also just negotiating an oil lease can take months in and of itself. And at the same time, this is a country that still has sanctions. Chevron is operating because they have a special, basically, waiver to operate, even though there are a lot of sanctions. There's one country we didn't talk about that I think is very important, especially if you see Exxon on the rise. They have a lot of assets in Guyana, and there's been a tremendous amount of concern that Venezuela would have some sort of incursion on Guyana. That has been a risk that has been completely removed right now for ExxonMobil in Latin America, even if they don't go into Venezuela.
That stock is up in the pre-market. Chevron as well, high by 6%. The broader equity market doing just okay, just about okay, going into the opening bell about an hour away, high by about 0.2%. Up next on the programme, we'll catch up with Aditya Bave of Bank of America, looking ahead to the December payrolls report. Plus, Danny has your morning movers. Another look at the energy sector, following the stunning moves over the weekend by the US government. The risk events piled high already to start the year in 2026. We've got payrolls on Friday. On the 13th, you've got bank earnings. JP Morgan kicking things off just around the corner. And then the next Fed meeting at the end of this month as well. They're the scheduled dates. The other risk factors you need to think about: Supreme Court tariff ruling, still waiting for that. That's one. And share price replacement. That's two. No dates for either of those two things.
I actually naively maybe thought that we'd be starting this week on your welcome back, first day back after paternity leave. Congratulations. We would maybe be talking about the Fed chair, the new pick from Mar-a-Lago that the president would have been announcing, not Venezuela. That didn't happen yet. We were supposed to have that in the fall. They keep dragging this out. We do know that he did have some interviews, though, over the Christmas break. So potentially we will get the Fed chair pick. And then tariffs is a huge question mark for this administration and what their steps forward is going to be, but also for C-suites around America.
Of the things that didn't happen in the last year, which were more surprising than the things that did, the lack of tariff inflation pass-through, one, I think, and the fact that the April 2nd story ultimately didn't matter to the equity market by the time we got to the end of the year.
Yep, it mattered for a few days, and then at the end of the day, the president said the bond market was a little bit yippy. He was pushing back on his policies that ended up being the Trump put when it comes to something that could recalibrate his policies. And then they went into full-on negotiating mode with these countries, and now we're starting out this year potentially with all those tariffs being evaporated if the Supreme Court deems IEEPA illegal.
So as we're still here deep into look-ahead season, just remember this. You can predict with accuracy what will happen. What is harder, much harder, is understanding what it will mean for financial markets. So even if you predict with accuracy what will happen, you can still get the market call wrong, which would speak to what happened with tariffs last year and a whole bunch of other things as well. Futures this morning higher by 0.25% on the S&P 500. On the Nasdaq 100, higher by 0.7. On the Russell, we're up by about 0.1%. This market game is hard, really hard. As we count you down to the cash open, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John, here are the winners of today's session, at least in the pre-market, and it is energy and oil-related stocks. Chevron seen as one of the biggest beneficiaries if the U.S. does take control of Venezuelan oil. Shares are up 6.25%. For Baker Hughes, that goes up 5.6%. Halliburton, 8%. So some of the energy equipment makers also doing very well. Elsewhere, it's much the same story for the start of 2026 as it was for 25, and that is AI stocks doing well. We're seeing a rally led also by memory chip stocks this morning. MU Micron up nearly 3%. SanDisk, those shares up 3.3%. Finally, ending things with a little bit of sell-side action. Estee Lauder getting a double upgrade from Raymond James, saying that their earnings has hit a trough. A rebound is going to happen both in the U.S. and Chinese markets thanks to product selection and innovation from the beauty company. So those shares up 3.7% in the pre-market, John.
Danny, thank you. Thanks for the update. More from Danny alongside Matt Miller in about 27 minutes' time as they kick off the programme. Count you down to the opening bell at 9 a.m. Eastern Time. Let's turn to the economy. We've got a full week of data on deck. Bloomberg's Mike McKee getting no days off. He joined us now for more. Good morning, Mike. What can we look forward to?
Well, good morning, John. Welcome back. And we got this in from the double secret Trilateral Commission headquarters in Washington. They wanted to make sure that nothing happened in the economy while you were gone. So now we can finally move forward with some data that will mean something, starting today with the ISM numbers from the manufacturing side. On Wednesday, we get the services side, plus ADP and JOLTS. ADP, JOLTS, ISM, that's the acronym day. Thursday, jobless claims and productivity. That'll be interesting. And Friday, of course, the December jobs report, and that'll be a full jobs report. So things to watch. One thing besides the numbers in the ISM reports is the company comments. We've heard in some of the regional ISM reports that companies are still uncertain about where the economy is going, and that's slowing down all of their decision making. Let's see what they have to say today. Productivity may be a tell on hiring and inflation. Hiring has been very low. Inflation has remained high. And yet if productivity is really high, then that could be good news on both fronts. We'll have to see what that tells us. The jobs forecast, 59,000 at the moment, and unemployment falling to 4.5% from 4.6%. And as you mentioned earlier, we're on watch for the Trump Fed chair announcement. Doesn't necessarily come this week, but it's going to come soon, I would imagine. But as to what you were saying about making predictions just before we came on here, I think back to Yogi Berra, who said, predictions are hard, especially about the future.
Well said, and well said, Yogi, as well. Mike, I just want to lean on some of the developments of the last 12 months or so. All these little pockets of tension in this US economy. Consumer sentiment's been rock bottom, not great, but spending's been pretty decent. Payrolls growth has been really sluggish and slow, but earnings have been tremendous, at least for S&P 500 companies and the larger companies in corporate America. Mike, how is the Fed thinking about these developments? The fact that you can have pockets of weakness out somewhere and then pockets of strength elsewhere.
Well, they're as uncertain, I'd put it, as everybody else about where this is going, and their forecasts really don't have a lot of confidence in them at this point because all these things are yet to play out. You were talking about the Supreme Court decision on tariffs and how that's going to move forward. And now we have this international geopolitical stuff that Donald Trump is doing. Good news for the economy is that it was a very quick and seems to have been decisive without injury to the United States move. But that could have really affected consumer confidence if we started a war where we started losing American lives. So all these things are on the horizon. And we just have to take it sort of week by week and data point by data point. Right now, the bet is we're going to see the Fed on hold in January. But I think that Ian Lingen at BMO put it this morning that that is subject to change at any moment.
Mike, thank you, sir. And particularly that moment on Friday morning, 8:30 Eastern Time, could change things all over again. Aditya Bave of Bank of America Securities writing, Fed policy in the near term will depend more on the labour market than inflation. Expect the decision to hinge largely on the December unemployment rate. 4.5% or lower should seal a hold. Aditya joins us now for more. Aditya, good morning.
Good morning. Thanks for having me.
Good to see you. Happy New Year. What are you expecting for Friday morning?
4.5%.
Okay.
Of the unemployment rate.
So hold over at the Federal Reserve.
Yes, so we don't think the Fed will cut again under Chair Powell, but just talking about the jobs report for a second, the unemployment rate is absolutely the most important indicator. We're looking for a drop from 4.6 in November to 4.5 in December, and the reason for that is that we assessed that shutdown-related distortions added at least a tenth to the unemployment rate in November. In fact, we think it could even round down to 4.4 in December.
Not to be too cheeky, but what if it is one of those 4.54, et cetera, decimal place unemployment rate? They are really on the line then, aren't they? How difficult is that call?
I agree. I think it's going to be a very close call if we stay around where we were in November, because then you're saying you get the same unemployment rate, but without those distortions. Then, to be perfectly honest, I think the Fed will fit their story to whatever they were planning to do anyway.
Is this going to be a clean read, or are there still distortions given the 40-plus day U.S. government shutdown?
December should be a clean read.
Okay, that's at least positive in that sense.
It should be a clean read. I'm still concerned about the response rates being somewhat low, but at least not distorted, just noisy.
So let's take the data that we've got so far. Mike and I were talking about it. Growth's been okay.
Yep.
Hiring's been terrible. Are you expecting jobless growth in 26 as well?
So productivity is the key theme for the Fed in the medium term. I think it's one of the most important themes of 2026. How does the Fed respond to productivity? This will determine the medium-term path of policy. So on the one hand, productivity is disinflationary. That means policy doesn't have to be as tight. But on the other hand, it also raises the neutral rate, which means you don't need to cut because you're already close to neutral. And we think that the Fed might end up leaning more towards the first argument, particularly with a new chair who's more dovish. And so we have another 50 basis points in our forecast for this year of Fed cuts, though honestly, we don't think that's necessary.
So let's just get into how you're framing 26. You've got the Fed chair, Jay Powell, and then you've got the next Fed chair.
Correct.
And under Powell, you're saying no cuts, no more cuts. And under the next guy, whoever it might be, you're saying 50 basis points. Is that because of who they are, or because of the economic data points you expect at any given time this year?
If you look at the 5 finalists, they've all leaned somewhat dovish in terms of policy rates. We think that with the current committee, it's going to be possible to get another 50-ish basis points of cuts, so down to around 3%. Below that will be very challenging, unless, of course, we're wrong on growth and the labor market slows down a lot more than expected.
One thing we've gone through throughout this morning has been the unintended consequences of pushing this committee to deliver lower interest rates, that somehow it's galvanized every single voter, and this is going to be a different regime under the next Fed chair. Is that how you think about the incoming committee too?
Well, the hawks have certainly been very vocal, and you're getting a couple of very vocal hawks rotating onto the committee this year. So if they do cut further, at least in the near term, at least without a significant deterioration in labor, you're going to get dissents from Hammock, Logan, possibly Kashkari. It's going to be tough for them to cut a lot more, again, unless you have the unemployment rate moving towards 5%, in which case there's no debate.
We haven't really talked about tariffs. Do you think that 2026 we can see more of the pass-through from tariffs on inflation?
So our estimate is quite similar to the Fed's, that there's been about 30 to 50 basis points of pass-through in terms of the impact on core PC inflation. So without the tariffs, we'd be somewhere between 2, 3, and 2.5%. That should continue through this year. There's going to be, obviously, the annual price increases at the start of the year. That could be an opportunity to raise prices. And then don't forget, fiscal stimulus is kicking in very soon, starting in February with tax refunds. So that pickup in demand as a result of fiscal stimulus could be another opportunity for retailers to raise
prices. And inflation
prices.
is already stuck above target, but you're more concerned about the labor market, even given all those reasons you just mentioned about inflation?
So there seems to be consensus at the Fed right now that ex of tariffs, you're in the low 2s. Will you stay there? Probably, but you could end up around 2.5%, which we think is uncomfortable, but the Fed seems to be okay with the inflation side of things for now. So in the near term, that's why we're saying it's going to be about the labor market.
Aditya, it's good to see you. It's going to be about the labour market throughout this week. Lots of labour market data going into payrolls. Payrolls Friday, just around the corner this Friday. Actually getting things on time, on schedule.
I'm so excited for that. And then Aditya saying it's going to be a clean read. I'm even more excited for that. Potentially no more of this noisy data because of, let's just call it the circus in Washington.
The circus in Washington. The median estimate, 59K for this Friday. The high is 155. The low is 25k. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Thank you. Chevron among the U.S. oil company stocks rising in the pre-market after President Trump said the U.S. plans to run Venezuela. Chevron is the only major American oil company currently operating in the nation. It is seen as best positioned to immediately benefit from more U.S. control over Venezuela's crude supply. The first buddy might be back. President Trump praising Tesla CEO Elon Musk after a dinner over the weekend. He said he's, quote, 80% super genius and 20% he makes mistakes. This all as Musk posted a photo of the pair and the First Lady, and comes after months of cooling relations between Trump and Musk. In sports, the Denver Broncos and Seattle Seahawks officially locked up the number 1 seeds for the NFL playoffs. Meanwhile, the Panthers were crowned the NFC South champs thanks to a Falcons win over the Saints, and the Steelers punched their ticket with a thrilling Sunday night win over Baltimore. Playoffs begin this weekend. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Just want to get you up to speed on a headline that just crossed the Bloomberg terminal. If you go to the commodity sector, you might think we're going to talk about crude, energy, but that's not been a story this morning. On the LME, the London Metal Exchange, copper this morning, just through 13k, very, very briefly.
Well, it had a 42% rise in 2025, post the best year since 2009. What's so interesting about copper is that we've seen the entire commodity complex move higher, but copper is needed for the energy transition, and it's really needed for the physical world. And also, there is concern from traders that potentially there's going to be higher tariffs on copper this year, and Trump is mulling that. So what do? The prices are going to go higher, and potentially you want to start stockpiling even more.
The copper this morning higher by more than 4%. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Gil Luria of D.A. Davidson on the year ahead for AI stocks from New York City. You're watching Bloomberg TV.
We come into the new year prepared for some volatility. Some of the themes from last year are continuing into this year. What I really sensed in December was a strong sense to rotate and to seek out value. And so there was a lot of interest in not just talking about the AI trade. And frankly, I wouldn't say everybody's like come to, to the moment where they hate that trade and want to abandon it. But, there's just more interest, frankly, in talking about what's cheap and what's maybe the next leg of that trade.
Good to start the year with Laurie Cavacina of RBC, looking ahead to a broadening out in the equity market for 2026. The average target in our survey here at Bloomberg for the S&P 500 is 75.55. The high is 8,100. That's from Oppenheimer. The low is 7K. That's from Stifel. If you're counting down to the opening bound this morning, that is about 43 minutes away, and your price action looks like this. Equity futures on the S&P up by 0.3%. On the Nasdaq 100 up by 0.7%. Pushing higher on small caps this morning. The Russell up by 0.2%. As we count you down to the cash open, here's the trading diary for the next 24 hours and the week ahead. At noon, Nicolas Maduro and his wife appearing in Manhattan, a federal court. Just amazing to see this take place here in New York City. At 4 p.m. Eastern Time, NVIDIA CEO Jensen Huang giving a press conference at CES. 5:30 Eastern, the Trump administration reportedly briefing select lawmakers on Venezuela. On to Wednesday, ADP data, jobs and ISM services. Thursday, another round of jobless claims, the big data point. On Friday, of course, is Payrolls Friday, just around the corner to kick off 26. Let's talk about CES and turn to tech. This year's shaping up to be the show me trade for the AI story. Gil Luria of D.A. Davidson writing 2026 will be the year we find out a lot about how much of a bubble we're in with AI. The first clue will be OpenAI's fundraise. Gil joins us now for more. Gil, welcome to the program. Happy New Year. Why are you focused on that specifically? And what does that mean for the broader ecosystem?
Well, a lot of the incremental spend that's been promised was promised by OpenAI. So if they can live up to that expectation of raising $100 billion of equity at a $750 billion valuation by the end of March, that will fuel the AI trade at least for the rest of the year. And that means a lot of the incremental players can win as well. Having said that, we're a little skeptical. That is a lot of money to raise at a very high valuation. They already had a little bit of a hard time raising capital 9 months ago from SoftBank. SoftBank had a hard time getting that capital. And that's when OpenAI was considered the leader, and it was at a $300 billion valuation. So it's very challenging, but if it does happen, it can fuel a lot of incremental players. Now, because those are the two scenarios, they're either successful and fuel the flames or not successful, and then we have to reconsider the AI trade. We're focused on the companies that win either way, and that continues to go back to Microsoft and NVIDIA. That original AI trade should work in a very wide range of scenarios.
It sounds like this OpenAI, whether or not they can raise the $100 billion of equity by the end of March, is really a litmus test for you. When you think about OpenAI, do you think they could take the reins back from Google's Gemini?
Well, that's one of the things that's going to have to come out over the next few months. As they fundraise, they're going to want to show what they can do. They want to show that they're going to want to have new models that, in their mind at least, are better than Google's models, so they can show that they still have leadership here. Because if they can't do that, it's going to be very hard to do this fundraise. If the leaders remain Google and Anthropic, then OpenAI is going to have a hard time justifying the financial targets that it's been setting, $100 billion in 2027, 200 to 300 billion of revenue by 2030, unless they have the best model, and the best model by far. It's going to be very hard for them to make that case. So that all has to happen imminently for them to be able to have a successful fundraise.
Gil, will you allow me just to draw a distinction between company analysis and stock analysis? And just let me ask you what you're offering here. Because when you say that OpenAI might receive pushback and NVIDIA can win in any kind of scenario, I understand that from a company specific perspective. They'll still make money. I've got that. But the idea that the stock will do well in that environment, can you explain that?
Yeah, the spend on NVIDIA comes from real companies that have real customers, right? So Microsoft, Amazon, Google have all the customers, all the business customers, and almost all the consumer customers. By the time you add Meta and all of the Elon ventures, there is enough demand there to live up to, for NVIDIA to live up to their expectations next year. In fact, they gave us the long-term guidance or guidance through this year for the first time in a long time. They have the orders for significant growth this year, and that's without even having China in the mix.
Play this out, though, Gil. Allow me to jump in. Let's say OpenAI has to tap the brakes because they receive pushback. Don't some of the hyperscalers that are rushing to compete with the likes of OpenAI then feel a little bit more comfortable, and they don't receive or at least feel the pressure of that existential threat coming from that company?
Well, those companies are building for us to be able to use chat. And they care less whose chat that is. So Google will build for Gemini, even if there is no OpenAI, which there will be. Let's be clear. OpenAI will continue, ChatGPT will continue to be successful. It's just a matter of how much spending money they have. And that use of ChatGPT will continue to come through Microsoft primarily and somewhat through Amazon. Anthropic will continue to grow. That will continue to come through Amazon. We are going to continue to use AI tools more and more. They are very good and they're getting better. The question is, how much fuel are we going to throw into the fire? And right now, there's enough real demand that can drive growth for those bigger companies. The question is, are we going to have this excess demand come from incremental capital and more leverage and more companies borrowing money speculatively? That's where we think we may came out short. And again, that's bad for the incremental players, not for those big core players.
But Gil, I hope you understand where I'm coming from here. That yes, those companies will still make money, but in a world where OpenAI receives pushback, can you imagine a world where the stock, NVIDIA stock, doesn't do well as well?
Now, that's possible, but let's not forget a lot of that money that OpenAI is raising is not for NVIDIA. OpenAI wants to build its own chips, right? That's Broadcom. They want to buy from AMD. They want to make their own hardware with Johnny Ive. They want to get into enterprise software. So their core spend which will probably continue anyway, will be through Microsoft and NVIDIA. The $100 billion they're trying to raise is their shot at becoming their own mega cap and spending on a lot of other things. They're trying to raise extra spending money that goes well beyond the compute they need for ChatGPT. And that's been fueling all these other stocks, your Oracles, your Broadcoms, your AMDs, your Oklos, even the quantum stocks. If OpenAI can't raise the $100 billion, they'll raise something. They'll continue to fuel ChatGPT, which again is Microsoft and NVIDIA. So yes, that's why we think Microsoft and NVIDIA will be fine either way.
Gil, thank you, sir. Gil Luria of D.A. Davidson, looking ahead to the year ahead for 2026. That wraps up the programme this morning. Easing into the new year, AMH, very slowly, very simply, this Monday morning.
Not quite. There's seismic shifts going on when it comes to geopolitics and foreign policy. This is not the conversation I thought we were going to be having to start the new year. I truly thought we were going to get a Fed chair announcement, and we didn't. But I always have to say, from me and the team, congratulations, and we are so excited you're back.
Thank you. Thank you very much. Got some experience of waking up in the middle of the night, you know, like 12, 1, 2, 3.
You've been prepared for this.
I've been ready. Been ready for like the last 10, 15 years. Here we are. Equity futures this morning positive by about 0.3% on the S&P 500. Lots to look forward to through the week ahead. Lots of economic data. The schedule shaping up as follows. On Friday, we've got a payrolls report. The following week, earnings from JP Morgan, the big banks kicking off earnings season. And then by the time we get to month end, which is going to be upon us pretty quickly, we've got another Federal Reserve interest rate decision. And a lot of the guests on this program pushing back against expectations for further interest rate reductions. Some, including Jim Bianco of Bianco Research, suggesting you will get no interest rate cuts under this Federal Reserve from both the Chairman Powell Fed and the next Fed too. Coming up tomorrow, Bloomberg Technology will have interviews with NVIDIA CEO Jensen Huang and AMD CEO Lisa Su live from CES. Look out for all of that. Coming up on Bloomberg Surveillance, we'll catch up with Julian Emanuel of Evercore, Emily Rowland of John Hancock Investment Management, Matt Hornback of Morgan Stanley, Liz Ann Saunders at Charles Schwab. From New York City this morning, good morning. Have a wonderful trading week. This was Bloomberg Surveillance.